Yeah, good morning, Seema.
Good morning, sir.
Yeah, so I think yesterday you missed some of the sessions.
Yes, I was busy in lecture, so I missed afternoon session.
Okay, okay. So, and no issue, we'll be sending the Zoom link for all the days.
Uh, you are going to provide the recordings, right?
Yes, yes, we'll do that.
Yes, sir. Thank you, sir.
Yeah. Yeah, good morning, Dr. Vemuri.
Good morning. Good morning. Good morning, sir.
Okay, so in the meantime, if you have any query regarding your project or the concepts we discussed yesterday, we can discuss. Let others also join.
Yes, sir. Actually, we
Yeah.
about the,
Yeah, Dr. Vemuri, I think you are not audible. Some connection issues are there. Yeah, good morning, Barka.
yes, sir. Good morning.
Yeah, good morning. Yeah, please.
I'm just looking for the currency exchange, how the fluctuations were happening because of the war. One is the Russian-Ukraine war.
Okay.
So that there's one aspect on, because 6 months data can I take hourly scenario, because war has started 6 months back. Of course, another 9 months in case I take, I can see fluctuations. That's my guess only. I'm not just guessing only. And secondly, I want to look for 3 countries or maybe 4 countries like Germany, UK, and Russia. But only thing is, I want to take hourly data or half an hourly data. Will it be okay to make some sensible argument?
If you are going for this hourly data, then a 6 months period it will be too long to understand the whatever because high frequency data if you're considering. So maximum 2 days, 3 days, the impact will be there of the Ukraine war. That's happened because of the market efficiency. You know that yes, new information has already been absorbed. So the asset prices will not be fluctuating based on the Ukraine war, because that's an old news in any case. So suggesting for 6 months will not be a good idea. If you are working on high frequency data, maybe you can take 3 or 4 days. You will have a good sample size. Maybe if you are taking even say 10 minutes data, for example, so 600 observations for 2 days approximately you'll be getting. Right. So 2-3 days is a good enough if you are working with high frequency data. But then in high frequency, the modeling is a bit different. So then we have to go for a heterogeneous autoregressive HAR model, we call it. And then you have to calculate the realized volatility. Then GARCH and all those, they are volatilities not based on the high frequency data. So if you are using high frequency, then you have to calculate realized volatility, HAR method for returns, right? So those kind of implications will be there. So what I will suggest is that maybe you can talk about the exchange rates with reference to the government bond yields or something like that, or stock market or petrol prices, crude oil prices, something like that. So that will be a mini project.
Will repo rate will be okay? Repo rate.
Repo rate again you'll be getting on a quarterly basis.
No,
So,
repo rate actually, when RBI gives some kind of a changes with the repo rate, will it affect the market?
Yes, it does affect, but every 2 months you'll be getting the repo rates.
Yeah,
right?
yeah.
So that will be a very low frequency data in any case. So what you are talking about is suitable for if you're working with a panel data kind of thing, not in a time series perspective. Right. So say you want to understand the impact of repo rates on inflation or repo rate on exchange rates. Maybe 4 or 5 countries you take, then you make a panel data on that, and then you work on that. So that will be a good study. But my suggestion is, I mean, since you're learning this time series, so better you take a daily data on any asset of your choice. Maybe you can take government bond yields, gold prices, cryptocurrencies are also there. Right. So those kind of things are there. Maybe you can work any one of them.
Okay, sir. Thanks. Thanks.
Right,
Yeah,
right.
understand. I understand that point.
Right.
Thank you. Thank you very much.
Yeah, good morning, madam.
Morning, Santanu.
Yeah.
Okay,
Yes,
a
yes.
couple of questions. Sorry,
Yeah.
I was trying it on SBI.
Yeah.
Now, SBI data, I pulled it out, etc. I got the 4 open, close, high, low,
Okay.
right?
Okay.
Now, how do I compress it into one? That bit I've got stuck on.
Okay.
Adjusted one, did I need to take a particular one, close or whichever one, and then adjust it, or how did I need to do it?
No, first you create a price series using the adjusted closing price.
Okay, that command is not working. Where am I?
Acha.
making
So
a mistake?
can you share your screen? Let me help you out.
Yeah. So it's working for all 4, and I got the graphs, etc. for all 4 then.
Okay, great, great.
Yeah, so here if you see.
Acha, theek hai, no problem. So what
so,
you, okay, this is the price, right?
correct.
This is the weekly data you have taken.
Ouch. No, daily data I put.
No, it's the result which is being shown.
Yeah, weekly, correct.
It's a weekly data, yeah.
Sorry. Yeah.
So what you do, just write in the command window somewhere. Whenever, whatever. Wherever.
Yeah,
It's,
tell me.
write SBI price new.
Oh. SBI price new.
Underscore new is equal to. You want to extract the returns or the price?
Yeah.
The returns, right?
Yeah, and then the returns on the price, because then I got the returns for all 4 of them. So yeah, the returns on the price, correct.
Right. So that means the 4th column you want.
The close one, correct.
Yes,
okay.
yes. So in that case, in line number 53, instead of price, you can write SBI return, so that you don't get confused. Instead of price, you can write SBI underscore rate.
Okay.
Underscore new is equal to SBI underscore rate. Select the last one. A dollar sign. That close you can select.
And then I don't do adjust.
Execute this. So now your SBI return has been created. So if you want to check this, type head. Head SBI. In the output window you can write.
Yeah,
SBI underscore rate.
New.
Yes.
Oh.
Okay,
fair.
So that column has been extracted.
Yeah. Okay, perfect. Thank you. Yeah.
Great.
And the T test is simple. T dot test.
T dot test. Yes.
Okay.
T test is basically the test for the mean value.
Correct.
Right.
And the T test and all, we can run it on this SBI Red, right?
Yes, exactly.
Yeah.
So that you can check whether the data has a normal distribution. Jarke test also you can run.
Right. Okay.
Great.
Thank you so much. I think that's where I need.
Great.
Yeah.
So what I will do, I will start the session today with a quick recap of what we have done, so that you get a hold of whatever the concepts we had discussed. So let me first list the concepts that we have discussed, and then I will proceed with the new data set, right, so that we get a practice. So we basically started with, I'm not getting into how to calculate returns and R function. Basically, I'm talking about the time series concepts. So the first important concept that we talked about yesterday was the moments, right? And we discussed 4 moments: mean, variance, skewness, and kurtosis. And looking into these moments, we could identify that whether the data has a normal distribution or not separately. So we tested for skewness, t-test, we tested for kurtosis, statistical significance. And when we find that they are statistically different from 0 or different from 3, then we conclude that yes, data doesn't have a normal distribution, right? So that is what we have done. Additionally, what we have done a joint test of normality, which is basically the Jarque-Vera test,
किसके?
right?
क्यों किया हुआ?
So
कौन सी?
in the Jarque-Vera test,
मीना भाटिया से बात हुई नहीं? तो मेरे को बताना. ठीक है.
yeah.
हाँ, उसको पता.
Madam, may I request you to switch off your
Sorry.
mic? Yeah, thank you. So in the Jarque-Vera test, the null hypothesis was that data is normal. And against this hypothesis, we tested whether the data has a normal distribution or not. Then, if data is not normal, then we have to search for the model for the return and model for the risk. So here we are talking about, today we'll be talking about ARMA models, right? And here we'll be talking about the Garge family models. So that is the basic requirement. And fourth, we have identified autocorrelation. That is the first step in our modeling. And autocorrelation test is basically a joint test. So what it does, let the series be say yt is equal to say alpha 0 plus alpha 1, yt minus 1 plus alpha 2, yt minus 2 plus alpha p, yt minus p plus this error term. So what autocorrelation does, basically the null hypothesis is that there is no autocorrelation in the data. So that means we are testing for alpha 2 is equal to alpha 3 is equal to alpha p is equal to 0, right? So that means this says that there is no autocorrelation. That means all the coefficients are jointly equal to 0. That means there is no correlation. And against this hypothesis, we have to test our first step, that is the test for returns. Autocorrelation in the returns. That is the step number 1. And if you have to proceed with your modeling part, so you need to reject this null hypothesis, right? If we are able to reject the null hypothesis, then only we can proceed for prediction. Because if there is no autocorrelation, obviously the series is a random walk. It's a series is a white noise, right? So we cannot make any predictions for those kind of series. So that means for modeling of time series, the first step is that we need to reject the null hypothesis of autocorrelation for the return series, right? And after this, what we do, we fit the model based on whether it is AR, MA, or ARMA model. After identifying a suitable lag. So that also we will learn today how to identify the lags. So once we fit the model, then we extract the residuals from the model, right? And then again we have to go for autocorrelation test of residuals. So for a good model, or if your model is good, there must not be any no autocorrelation in residuals. This you must, that means here you need to accept null. So in the first step, you have to reject null. In the last stage, you have to accept the null. then you say that my model is complete. That means you have identified a suitable model. Right, so this is the step, or these are the steps we need to remember. So any question in this? Okay, great. So today what I will do, I will just start with a new data set. Maybe you can do with me, and let's test a different data set whether autocorrelation is present or not. So today we will be taking NTPC, for example. So get symbols. NTPC dot ns from equals 2015 1st Jan 2015 till yesterday. If you don't write 2 in this command, what it will do, it will download the data for the most recent period. That means till yesterday it will fetch the data. So you need not even write 2. But if you want the data, don't want the data till yesterday, then you have to define the 2 date. So let us execute this line. Then NTPC price is equal to NTPC, press a $sign and take the adjusted closing price. And it's better that you write here NA.omit from the beginning itself, so that if any missing values are there at all, it will get removed in the very first line itself. And you can check also which is dot NA NTPC price. There is no missing value in this case. And finally, let us calculate the return. So NTPC underscore ret is equal to diff log NTPC price. And just check whether NA value is there or not in the first observation. Yes, NA is there. What you have to do here, right? -1. So now you are ready with the return series. Are you done up to this part?
Just give 2 minutes.
Yeah, please take your time.
Sir,
Yes.
sir, I'm not getting this get symbols. So first I have to recall, matlab, library
Acha.
quant mode or library clipper.
No, you run the library quant mode once again.
Okay, sir.
Many times it happens if you close your computer, so you have to recall all the libraries. Please let me know when you are done. Yeah, Barkha, your get symbols is working now?
Yes, sir.
Okay, okay, great.
Yes, sir. I could do up to this.
So you have calculated up till return, right?
Yes.
Done, sir.
Yeah, that's right. Yeah.
Right. So let's have a visual check of what we have done. So first we plot NTPC price and type is equal to L, just to see what is the trend of this particular graph. So this is what we are getting. So from 19, it has been going up. So that means there seems to be no impact of pandemic on this stock price. So it has gone up from around 75 rupees to 160, which is quite a good jump. Okay.
Sir, I just want to know, the
Yeah,
jump, can we connect the jump with
yeah, Dr. Vemuri, I think your voice is not clear today. It's some connection issues are there, it seems.
Okay, sir, you carry on. Maybe some
Okay.
problem, but I just want to see, say, I mean, the peak
Yes.
that whatever we are getting for NTPC,
Uh-huh.
can we connect with that COVID? I mean, is it really how to
Yes,
really
to an extent you
support
can
our
connect.
arguments? Yeah,
Right,
yeah.
right. Because during COVID, the demand for power also substantially increased. People were working from home and everybody was saying,
Okay,
right. So maybe
okay,
that.
okay, okay.
But on the contrary, yes, industrial activities were not stopped. Right. It's only the MSME
Yes,
sector which was stopped and the service
yes,
sector which was stopped, but not the production part.
yes, sir.
So you can connect it with the increase in demand also of electricity during that period.
Okay, okay.
That could be one possibility. Or because if you talk about fundamentals about the company, so that you have to check their balance sheet ratios. What has it improved over the last, which is getting reflected in the stock prices. That way
Okay,
you have to do some analysis.
okay.
Okay, one good thing that in R also you can plot the candlestick chart if you want to see, and candlestick chart you can plot in open, high, low, close. So that also you can do. For example, there is a function called as chart series. And if you type the NTPC, the original data, like this. And if you plot it, you will be getting the candlestick chart. So candlestick charts are very helpful in technical analysis and all those things. So if you want to go deeper into this, you can look into this particular graph. So this graph is very clumsy. Right, so I will just tell you what to do. Background is black. If you want to change the background also, that also you can do. Just type theme is equal to white.
Sir, I am not able to plot the graphs. It is showing figure margins too large.
Okay. Yesterday I gave you 3 lines per MF call. You remember?
Yes, yes, sir.
Run the last two second, middle one and the last line, and then you plot again. These 2 lines. Run only just 2 lines, and then you plot. So, say for example, you want to reduce this particular chart and you want to see only a specific part of this chart. So that also you can do. Say I want to see the data from say 2022 Jan till 2022 Feb. Just write this command. So what it will do, it will give you the graph only for the 2 months period. And then if you see the graph, it will be more interpretable. So you can change the lines also, I mean, the date range, and you want to see in more detail. So that also you can do. I'm giving you this code in the chat box. You can copy it. Just let me know if you are getting these 2 graphs.
Yes, so it is working now.
Right. So both the plots you can plot, right? And simultaneously you can also plot the return series. It's NTPC underscore and type is equal to line graph. So this is what we have got. So this is what you'll be getting, except few periods of spikes. It seems to be very consistent. Okay, are you done with this part?
Yes, sir.
Great.
Yes, sir.
Okay, so I will tell you 2 more important plots. First is the scatter plot, for example. Say you want to understand the correlation between 2 different stocks. Say State Bank of India and NTPC I want to plot. I want to see what is their correlation. Right, so that also you can do. So for that, what you have to do, just get SBI for this particular data period. So SBI, or I will take another company, maybe say, let me just check. Any Indian company, maybe Bajaj Finance is there. So let's take Bajaj Finance. So Bajaj Finance. So let me take Bajaj price. So there are no missing values. Sorry, this one, Bajaj price. So no missing values, but now we need to check the length of the two series, right? Length of NTPC price, 1800 observations, and in Bajaj, 1889 observations. So absolutely fine. And then you type Bajaj underscore ret is equal to def log Bajaj price -1. Now returns we have got Bajaj and NTPC. And I want to see what is the correlation, what is the relationship between these two stocks, the returns of these two stocks. So that also can be done. So two things you can do. One is you can COR, is basically the correlation between Bajaj return and NTPC return. So 28%. So there is a positive correlation. Between these two stocks.
Sir, please wait.
I'm waiting. I'm waiting.
No, I'm getting an error in it.
Okay, let me just check. Acha, not income. In from in line number 236. From is equal to quotation you have to give first.
Okay.
and close the quotation this side. Now you
Okay,
run
so
this
in
first.
in both cases, yeah?
In both the cases, yes. Now
Okay.
execute this line again. 237. 237 also you execute.
Yeah.
And 240.
Yeah. And similarly do it for Bajaj, right?
Right. And then you can check a length. Instead of 241, you have written a head. You can type the length. Or you can type it separately also. Just execute this. 1888.
88.
Observations.
Yeah. Okay. And similarly do it for Bajaj.
Similarly
right?
for Bajaj Finance, yeah.
Okay.
Just copy those lines and keep on replacing.
Change it.
Yes.
Okay.
Done, sir.
Yeah. Are you getting?
Sir.
Okay. What is the correlation? 28%?
Yes, sir. Same.
Okay. Great. So it is positive correlation.
Yes.
So the same thing you can also plot. Like so, type Bajaj return. This tilde sign in a system and NTPC.
Sir,
Yes,
so what is the symbol after Bajaj return?
it is tilde just in the keyboard. You see in the numeric 1 on the left hand side of 1.
Okay, sir. Okay.
Shift and then you press that. Are you able to get the graphs?
No, did you plot them both together?
No, what, just type this tilde sign you have to give first.
Sorry, come again.
Tilde sign, you're just on the left side
Yeah.
side of one.
Yeah, yeah. So once you have to put it, right?
So then you have to type NTPC underscore red. Basically,
Underscore red.
it is plotting the correlation graph. But somehow I'm not getting it today. Maybe in your system, just check. I don't know what is the issue with this today.
It's not coming here.
Not coming, right?
Yeah.
Yes, sir. I'm also getting an error in external graphics.
Okay. Actually, you'll be getting a graph like this. Although this graph is not important, but yes, still, if you want to, this plots a correlation. So it will be plotting something like this. So here it is Bajaj, and here it is NTPC. So this relation will be approximately equal to 0.289, which you actually got R. Right. So let me just find out what is the issue. So I will just check what is the issue with that. Yesterday we were talking about the ROC also. ROC is you can download directly. I mean that can also work. Yesterday our data format was not in the appropriate format, so that's why we were not getting. But yes, today if time permits, I will show it to you how to do that written calculation on the entire matrix. Anyway, this correlation also you can plot, and finally I think you can do a correlation test. Whether the correlation of 0.28 is statistically significant or not, that also you can do. Correlation test between. So what is the statistical significance of this correlation? Right. So here it is. The null hypothesis is that the correlation is not significant. Right. So here you can write the null hypothesis, correlation not significant. Since my probability value are all greater than less than 1% or even 5% in that case, so we can reject the null hypothesis. So we say that yes, the correlation is statistically significant. So even if it is mathematically, it is a very low value, but yes, it has some statistical significance. We cannot ignore this. Right. So these two simple tests you can do, and just to understand what is the correlation. Right. Especially these things will be helpful when you're going for portfolio constructions or when you're going for co-integration tests, co-integration relationships. So those kind of things, understanding the correlation will also help you. Okay.
So
yeah.
So there is an issue. It is saying it could not find function correlation test.
Acha, so you run library app basics.
Okay, sir.
Then it will work.
I think, sir.
Yeah.
We can plot a trend line also if that graph comes.
Yes, after the scatter plot comes, then the trend line is also possible to plot.
So that will also give that correlation.
Exactly.
Okay.
Right. Okay, so should I proceed? So let us first do the normality test of NTPC return. And let us do the test for Bajaj Finance, so Bajaj return. So what is the conclusion you can draw from the results? So we do the joint test of normality.
Sir, what was the null hypothesis for correlation test?
There is no significant correlation. This one.
Okay, so p-value is less than 0.05.
Right. So you say that yes, relationship is highly significant. आप SPSS में भी करते होंगे तो वो नीचे कभी-कभी T statistics का P value report होता है in the correlation table, right? That is basically to show that yes, whatever we, and this thing will be required when you are writing a research paper. You have to do a correlation matrix, right? So in that case, you have to report what is the significance of that, statistical significance of that test, whether it is significant at 1% or 5%, right? So that also is a part of your descriptive statistics. So for each of those assets that you have selected, you can you have to report the correlations, respective correlations. ठीक है, should I proceed now?
Yes, sir.
Okay. So Jarque-Bera test we have done for NTPC return and Bajaj return. So what is the conclusion you are able to draw? Since the probability value in both cases is less than 5%, so we reject null hypothesis of normality. So we conclude that data doesn't have a normal distribution. So that thing we have confirmed. Right? So Jarque-Bera is a chi-square test. So you can report that in your descriptive statistics table, JB test kind of thing. And second, test of white noise or autocorrelation. Right? So it is basically the joint test of white noise. Whether the series can be predicted or modeled or not, that is the test we have to do. So which test we can use? You have to use the box test. NTPC underscore ret and type is equal to Belgian box test and lag. At both lags you can test lag number 10 and lag number 20. They are the standards to be reported in the research paper, so that's why I'm talking about 10 and 20. So check your results. Can you conclude this result? Anyone? So we are getting a box test probability value of 1.2%.
It is less than 0.05. So that means
Ah.
we will reject the null, and it means data is autocorrelated.
Right. So if you are testing your hypothesis at 5%, then yes, you need to reject. But if you're testing at 1%, then you need to accept this null. Right? Because it is 1.2%, a bit higher than 1%. So depending upon what is your confidence interval, either you accept or reject, right? So, but normally we test our hypothesis at 5% level. So at 5%, this hypothesis is rejected and we say that there is some
Autocorrelation.
there is no autocorrelation in the data series, right? That is a null hypothesis. So which you reject and you say that yes, there is some autocorrelation, which means that NTPC return can be predicted. It can be modeled. Similarly,
Sir, what is significance of this lag is equal to 10?
where
Lag 10, what is the, why we are
lag means we are going up to the lag. Say for example here we have taken now alpha 1 is equal to alpha 2 is equal to alpha 3. We are going up to 10th lag. That means we are testing whether there is any autocorrelation up to the 10th lag. That means since it's a daily data, so you are going beyond 1.5 weeks approximately. Right. So you're testing that yes, last 10 days, if you check the data, do they have any some kind of correlation or not? And similarly, you extend it for 20 also. Alpha is equal to 10, alpha 20 at alpha 20 also you test. So they are the standards in the research paper. So that's why you need to report. So when you report, I told you yesterday also that when you report the statistics, you have to write box test at 10 and box test at 20, or simply write Q10, Q20. Right. So you have to report these values. So probability value, either probability value you can report or the chi-square test, the chi-square values, any one of them. At 20 also you can test what is the value you are getting. So at 20 it is again you reject 5%. And similarly for Bajaj return also you can check. In the 10th lag. So it is strongly rejecting the null hypothesis. Right? That means we can fairly conclude that yes, both these returns can be modeled, can be predicted. Okay, so any questions so far?
Sir, I have a very basic question.
Yeah.
So if we get a p-value in e terms, this exponential terms, so how should we interpret this?
It is not e actually. It is decimal is on the right hand side. That means after decimal there are, in this case it's a e to the power -6 है ना ये? E
Yes.
-6. इसका मतलब है कि decimal के बाद 5 zeros are there.
Okay.
So it is actually 0.000000979.
Okay, sir. Okay, got your point.
Right. So that is the probability, right? So which is less than 5% in any case. Okay. Any more question or should I proceed?
Sir, just I want to know one simple thing.
Yeah.
Yeah, actually, when we plotted the correlation between NTPC and Bajaj, we didn't get any correlation. It was around
Right.
maybe
That
0.2,
plot we did not
0.28.
get. I will just try to find out. Maybe I'm missing some of the codes.
That's fine. That's fine. I mean, when we given the command correlation, the correlation was very poorly correlated between NTPC and
Yeah,
Bajaj.
but it is statistically significant. Yeah.
Here, when we do this box test,
Dr. Vemuri, I think your sound is very, very less. I'm not able to hear anything.
okay, I'll leave it. I'll leave it. I'll talk maybe a little later.
Maybe you can check your mic somewhere. It is creating issues.
Okay, I'll check it up. Thank you. No,
Haan.
I'll talk to you again.
Okay, Shantanu, sorry, I'm again getting an error in this.
Achha,
Box test.
let me just check.
Yeah.
Okay. No, Ljung in the first one to line number 270. J is small. No, Ljung box, J is small. Now you run this.
Okay. Right. Thanks. Yeah, it worked. Thank you.
Right. Okay, great. So, so I think you have now tested the normality and you have tested the autocorrelation of NTPC and Bajaj. Now we are ready with our next step. That is the concept of stationarity. So let us talk something about that and then we will do some testing. Right. The concept of stationarity is very important in time series because stationarity has its dictionary meaning, right? Anything which is stable, right, which is time invariant, we call it as a time invariant. So the property of time invariant is called as stationarity. Anything which does not change over time, right, which is assumed to remain constant, is called as stationarity or stationary. So this concept is very important because in time series, we cannot make any kind of predictions unless and until the series is a stationary series, right? Now, for example, let me plot a price, right? It is my time and say NTPC stock price. Now the stock price is moving something like this. You have seen that, yes, it is moving in this direction. Now this kind of series are said to be non-stationary series. Now, why it is called as a non-stationary series, we will come a bit later. So obviously, any kind of predictions, any kind of modeling, we never do on price series. That is the reason that we need to convert the price series into a return series. Then only we can make some predictions. So once the series becomes stationary, I can make some predictions about the direction of that particular movement. You must have heard about a concept called as a random walk. Right? A random walk is basically a concept which has been borrowed from physics, right? Which is called as the Bernoulli's properties. Bernoulli's theorem. Now, Bernoulli's theorem, what does it talk about? It tells you that the molecules in water or molecules in any medium, they move in a zigzag manner. You cannot make any kind of predictions, right? So you don't know where it will go after at any given point of time. You cannot make any kind of predictions. So this movement, this behavior of a particular molecule, or in this case a time series, is a random walk. Random walk, it cannot be predicted. We can't predict. We can't predict because we don't know where this direction will move towards tomorrow. Right? In our day-to-day life also, we say that, yes, don't speak to that person because you don't know what his mood will be, something like that, right? Because you can't predict. You don't know. But if you approach a person and you know that, yes, whenever you meet him, you will always feel happy because he always talks positive. So he's predictable, right? But the other person is not predictable because you don't know what the mood of that person is today. So you cannot make any predictions, right? So predictions become easy when the series is not a random walk. That is the simple concept. In essence, that we are talking about stationary series. So random walks are non-stationary series. So how this random walk is denoted? Let a series be yt, right? It is equal to yt minus 1 plus an error term. That's simple. Right? Not, it is mu plus an error term. Not this one. It is mu plus the error term, where mu is the mean. That means I am aware of the mean value. I know the mean, what is the average, but I don't know what the next day's price will be, because on this mean some error term is getting added, and this error term is random. Error term is noise. So this is basically a white noise, right? And we say that this error term has a normal distribution, or it is basically a white noise. I cannot make any kind of prediction. So since I cannot predict error term, I cannot predict the next day's value. I cannot predict what will be the value of YT. Right? So when you face this kind of equations or this kind of situations, we call that the series is a random walk. So if you go by that logic, this kind of series, like say it is moving in this direction, somewhere it is coming, maybe it is a price series of the stock. I know that yes, there seems to be a positive trend here, but I cannot accurately make any kind of prediction, because trend is basically it is an average. It is a long-term average, but it does not talk about that. Suppose the value is today at this point, where it will go, whether it will go to this side or come to this side, or it will go to this side with this side. I don't know this. It means the next few days, 2 days or 3 days predictions become impossible for me. On a long-term basis, yes, I can see a trend, but on a daily basis or a weekly basis, if I want to make any predictions, yes, I'm not able to do that, because I don't know where the direction of this movement will be. So what we do, we need to convert this non-stationary into a stationary series. So convert this stationary, non-stationary series to a stationary series. Right, so that is the basic concept of stationarity. So how do we understand, right? How do we understand that whether the series is a stationary series or not? So let's talk about some more concepts here. So stationary. There are two types of stationarity we have to deal with. One, it is a strongly stationary, and one is a weakly stationary. Right? Strongly stationary series and weakly stationary series. Strongly stationary series is basically a theoretical concept, and this is used in practice. Right? So that means by default, we are always working with stationary time, your weakly stationary time series, not strongly stationary time series. So what defines strongly and weakly stationary? Right? That is what we are going to talk. Is the concept clear so far? I mean, what we are talking about?
Yes, sir.
Okay. So let us understand this concept of stationarity from, again, we have to go back our idea of moments. So let me list down the moments that we have identified. The first moment is mean, variance, then skewness, kurtosis. These are the moments we have talked about. When we assume that, if we assume that all these moments are time invariant, then the series is called as a strongly stationary series. Strongly stationary series. So here what we are doing, we are saying that even the quartiles, here the higher moments also, the quartiles are also there. So if we assume that all the moments of any distribution are time invariant. That means they do not change. Then we say that the series is a strongly stationary series. But in practice, it is almost next to impossible that we find that all the moments are time invariant, especially skewness, kurtosis, quartiles. Right? You will find they are changing over time. So that means we have to work with and we have to relax that assumption. And we say that, okay, if skewness, kurtosis, or quartiles or other moments are not time invariant, let me work with only moments. If they are time invariant, then we say that it is a weakly stationary data. What we are doing here, so we have relaxed our assumption, we relaxed our restrictions, and now we are focusing only on the first two moments. And we say that yes, if the mean is constant, mean is time invariant, and the variance is also time invariant, then the series will be called as a weakly stationary. Right? And it has been empirically proven that yes, these two things actually are more or less, they remain time invariant, right? So how this thing can be achieved? So is the concept clear? What is strongly stationary? What is weakly stationary? So strongly stationary means if you are saying that my kurtosis is also not changing, my skewness is also not changing over time, they remain constant, then you're talking about strong stationarity part, right? But over the period, you will find that yes, these two things are changing. Now, why that price series is not a stationary series? For example, you take a series like this and you divide this time series into maybe 2 or 3 parts, this one or this one. Let it be A and let it be B. Calculate the mean of A, calculate the mean of B. You will find that this is not equal to the average of this particular time period. You can test it, you can do it on your own. In the case of NTPC, we have done that. When the stock price was 60 rupees or nearing about 60 rupees, now it is talking about 160 rupees or so. So that means if you divide the sample in the last 1 month and 1 month data in 2015 and calculate their averages, you will find that the averages are quite different, right? In 2015, the average price was around 60 rupees, but now the average price is around 110 rupees. So that means since the average has changed, so we can fairly conclude that yes, it is not a strongly stationary because one of the conditions is violated. Then obviously we have the variance. You can also calculate the variance of these two A and B time periods. Again, identify whether the variance are same or not. You will also find that the variance are also different. So you say that variance of A is not equal to variance of B. So since these conditions are violated, we say that yes, they are not strongly stationary, right? So that is why we consider price series to be non-stationary series. That is the reason that price series are non-stationary, and we do not model any time series based on price data. So we require a stationary data, and that stationary data is provided by returns. Right, so that is the idea. Is it clear?
Yes, sir.
Right, so in weekly stationary, assumptions that we work with is the expected value of a time series, maybe say YT, is constant, let it be mu, and expected value of variance is also constant. So see, there is no subscript here. So this is assumed to be time invariant. So there is no T subscript here. So since there is no T subscript here, so we are basically constant. The variance is constant. When we have this return series, so you have seen in the data, this is close to 0, and we are getting a value like this. Some return series we have plotted today, right? You see the variance is moving in a constant range. It is moving in a constant range. So the variance will be in this particular range only. And the average value, you take any sample size, will also be very close to the mean value. So these two assumptions are possible, or these two assumptions we find in the return series. And that is why we say that return series are stationary. But only saying will not do, right? You have to, again, as usual, you have to do some statistical test, whether the series is a stationary series or not, right? In financial terminology, we call it as a problem of unit root. So unit root are basically indicating presence of non-stationarity. Right? So when we say that yes, data has a unit root or the series has a unit root, which means that we are talking about non-stationary series. So various tests are available to us. First is the augmented Dupuller test. Or in short, we call it an ADF test. Second is PSS test. Third is Zyvot and Deuce test. Right? Most popular is the ADF test. Right, so we will also focus on this one, although I will tell you about the KPSS. The only difference between these two is basically the null hypothesis. They're exactly opposite to each other. Zyvot and Deuce test is done to test for unit root under structural breaks. Right? So you might have come across this particular terminology, structural break in the time series. So if you want to test for unit root in the presence of structural break, we have to use the Zyvot and Deuce test, right? Otherwise, if you are not assuming any kind of break there in the series, so we can go ahead with the first two or any one of the first two. So the null hypothesis is that in ADF test, null hypothesis is that data is unit root. That means we are saying that not stationary. And in KPSS test, the null hypothesis is that data is not unit root. It is exactly opposite of the ADF test. Right, so these two tests we can do to understand whether the data has a stationarity or not. Okay, so are you done with this part so far? Should I proceed with the data?
Yes, sir.
Okay. So now let us do stationarity test. So two libraries you require, library F unit roots. This library you need to install first. Check in your system. If it is not installed, you can install it. And library series. So library T series you have already used yesterday. You need not install it. It's there in your system. You're done? The installation part?
Yes, sir.
Yes, sir.
F unit root and library T series.
Sir, I'm not able to find F unit roots. Should
Uh,
I do a CRAN?
in CRAN only you will be able to find?
No, I search CRAN as well.
No, you go to packages, then install. F unit root must be there. Here it is.
Okay, got it, got it. Sorry, thank you. Yeah.
But Shantanu,
Yeah. Yes, ma'am. You have any query?
But F unit roots is not coming for me.
No, I'm not getting you. I mean, hello.
yeah, no, I'm fine.
Okay. Okay.
I think Dr. Vemuri was asking for.
Okay. Okay. His sound is today. I don't know. It's very very feeble. I'm not. If unit is not possible for me. Okay, why? Are you not able to download? Let me just check. Okay, no problem, no problem. At least you can use this series also as an alternative. Okay, right. So the command is adf dot test is also there, which is under library T series, and say NTPC underscore. First you do for price. Run this.
So which one should we do? T series one or the unit root one?
No, since I think you can use both of them, because I think Dr. Vemuri is not having access to F unit roots.
Okay.
So you can use this as an alternative. Both will give you the same result. ADF test. This is under unit root. F unit root library. You will always get the same conclusion. Any one of them you can do. So this is under library F unit roots. And this is under library T series. So first you run on the price series. How much you are getting? Say under this library, if you have used the type under library, so 0.72 is the value, right?
Yes, sir.
So what is your conclusion then? Interpretation?
So will
You will accept the null?
null. Yes, sir. That,
Right, and
that
what
the
is your
series
null?
has a unit root. That means the
that
series is not
It's
stationary.
not stationary, huh? That is what we discussed in the concept also.
Yes.
Because it's a price series, and we discussed that price series are not stationary, which you are not able to confirm through this test. So you can write null hypothesis here. Series has unit roots or not stationary. So this is my null hypothesis. So which you are able to accept in price. And similarly, you do it for return series. ADF dot test NTPC underscore get. So you're getting a value of 1%. So then you reject the null hypothesis at 5%, right?
Yes, sir.
Yeah. Yes, ma'am.
Yeah, so my question was basically what I figured out was that if the NTPC price is non-stationary,
Yeah.
right? So then effectively we do the difference in the log, and then that's how we come to NTPC
Right.
return,
Exactly.
right?
Exactly.
Yeah,
Exactly.
so- and I'm just talking from when I take an economics variable also, I'll follow the same course, right?
Yes. Yes.
Oh.
So, for example, in economics, you will find that, for example, foreign exchange rates, inflation,
Yeah.
they
Yeah.
will not be stationary. You have to make them stationary first.
Correct. And the same, then -1 log difference and -1.
Yes. Yes.
Yeah.
Yes. Yes. Right.
Okay. Thanks. Also, could you just tell us multi-collinearity whenever there is time, please? So,
Okay.
because
Okay.
generally,
Okay.
economics, we take a couple of them there. Yeah.
Acha, acha, ठीक है. In R you want or in the concept you
Yeah.
want?
In R.
Okay, okay, right.
commands in our, yeah.
ठीक है, I will do that. I will. Okay, so everyone is getting this result. Just write your conclusions and just do it for Bajaj Finance, also Bajaj price and Bajaj return. Just identify whether the series is stationary or not.
Yes, so same. The result given, Bajaj price is non-stationary and Bajaj rate is stationary.
Stationary, right. So that means your return series, you are finding that they are now getting stationary. So, and that is the reason that we have to model using the return series, not the price series. Right, so we always work on stationary time series. So this is the objective. This is the reason that why it is required, and you need to do some test, basic test. So this test also you need to report in your research papers as a part of descriptive statistics. So somewhere in the beginning you have written so X, Y, Z stocks, so you have taken average, variance and all those things. Then JB test you have to report, Q10 you have to report, Q20 which is autocorrelation, and then you have to talk about the ADF test. And after this we have to report ARCH 10, ARCH 20. So this is basically the sequence of, or they are the part of the descriptives statistics. CB statistics you have done, autocorrelation you have done. Now you have to report the ADF test. So this 3 tests, and the 4th one will also be important for us. These tests so far are indicating that yes, why have I used the particular model, right? These are basically the justification that you're trying to give, that why have I used any time series model. So I find that yes, data is not stationary. There is autocorrelation in the series. Data is stationary, and that's why I have come across. I'm come up to this particular model. So it is basically justification you're trying to give, right? Okay. So take up to this part. I hope it is clear.
Yes, sir.
Great. So चलिए फिर it's already 11:30. Let's take a break of 15 minutes. And we'll meet at 11:45. Will that be okay?
Yeah.
Okay, chali. Let's meet at 11:45 now. 15 minutes break. So I hope all of you are back.
Sir,
Yeah.
please one query, like when we are dealing with multiple variables,
Okay.
so do we have to follow the same step that we have to check Jarque-Bera test and autocorrelation
Yes.
individual variables?
Yes. For each variable, for each asset, you have to test it and report it also. As a part of your descriptive statistics table, right? Any more queries so far?
No, sorry, what was the query? Sorry, yeah.
Yeah, madam. Any query?
No. Ria asked something, right? Ria?
Yes.
Yes, ma'am. I was asking for when we are dealing with multiple regression, then we have to do this test for individual variables, or there are some tests for multiple regressions.
No. Normality you have to do individually only. It's a joint test, but joint test for individual variables.
So, sorry, Shantanu, so we'll go variable 1, variable 2, variable 3 separately, we'll keep doing, right?
Yes.
And once the model is made, then the robustness of the model, then we'll run all of it together.
Yes, that depends upon, suppose you are going for a univariate model. So you fit the model and then you test the model. That's all. You don't have to do anything else. But
yeah,
if it is
but no.
yeah.
Go
But
ahead.
if it's a multivariate data for your model, for example, multivariate time series data, then there is a multiple test also available, right? Like say, for example, we want to test the arch effect in the multiple multivariate setting. So in that case, we have one common test available to us.
Okay,
so that depends upon what is your research question, and are you going for multivariate data or you are going for univariate modeling. But descriptive statistics has to be reported for each and every asset that you are considering.
Right. Okay. And so you will also take us through for multivariate this thing?
Yes.
Okay.
So I think tomorrow we are going to start this. Tomorrow.
Oh, okay.
Tomorrow and day after tomorrow is dedicated. Tomorrow's last session and day after tomorrow, entire session is on multivariate.
Oh, fantastic.
Yeah.
Okay. Yeah. Thanks.
Okay, I think everyone is back. Harsh, Seema, Dr. Vemuri.
Yes, sir.
Okay. Great. Dr. Vemuri, I think today you are facing some issues, technical issues at your end today. Okay, great. So we will be providing you all the recordings, so don't worry about that. Actually, Zoom takes around 24 hours to generate that link. So the MDP office will send all the links to you, having the recordings. And in the meantime, okay, right. And in the meantime, I will also supply you all the things that I am writing on in a PDF format on a daily basis. You'll be able to get, so that if you want to make any reference, that also you can do. Okay, so let us proceed with our next part. That is our written modeling. But some concepts first, and then we'll go for the modeling part. Okay. First is then we have identified that if autocorrelation is present in the data in the written series, in the returns, so we can use 3 models for returns. First is the autoregressive model, which is basically the ARP model. Second is moving average model, which is basically MAQ model. And finally, we have the ARMA model, which is basically the combination of these two, ARMA PQ model, where P and Q are the lags. These lags are to be selected, right? So if you find that yes, autocorrelation is present, then we are ready with our first part of our modeling, that is the modeling for the returns. And for that, we can use these three methods, either AR model, MAQ model, or ARMA model, right? Depending upon what kind of results we get. So we have to select the most appropriate one, right? So let us start with the steps that we are going to do, right? First step in all the models is to identify the lags. Thus, identification of suitable lags. That is step number 1. Right? You can say step number 1. For all the models I'm talking about, identification of suitable lags. Second, fitting the model using those lags. Third, extracting the residuals. Fourth, do a box test of autocorrelation on residuals. So if no autocorrelation in residuals, then your model is appropriate. And this can be used for prediction. Right, so in these 5 steps, we will discuss all our models. ठीक है? So any question on this? Zygot and use test. Okay. For that, you need to run a new library here. The library is a struct change. Struct change is the library that you have to install, and in that library you'll be able to get ZA test. Right?
Okay, sir.
So okay. These steps are clear. What we are going to do, you need to remember these steps because that will help you to move in a sequence, right? These things are not very difficult, so it will be very easy for you to implement it today, right? So once you understand these 5 steps, then the rest of the things are very easy. So first is identification of the lags, fitting the model using those lags, extract the residuals, then we'll have to do our autocorrelation test on the residuals. And if no autocorrelation is present, then we can say that yes, model is good. If the model is, if autocorrelation is present, then yes, we cannot, we have to refine the model, right? So that is what the steps involved are. So let us see the first model, that is our AR model, ARP model. And we'll start with a very simple model first. Let yt is equal to alpha 0 plus alpha 1 yt minus 1 plus the error term, right? This lag, since we have considered only one lag, this kind of models are called as AR1 model, right? They are called as AR1 models because there is up to one lag we have identified. Similarly, you have yt is equal to alpha 0 plus alpha 1 yt minus 1 plus alpha 2 yt minus 2 plus the error term. So this is basically AR2 model, and you can proceed like this. So yt will be equal to all these things plus alpha p into yt minus p plus the error term. So this is basically the ARP model, right? So P here stands for the lags. Now the problem is, since we can have P lags, P is indefinite, right? Should we go up to 20 lags, 25 lags, 15 lags, 10 lags? What need to identify which will give us the best model? Now there are some problems that we may encounter. Now while modeling a time series, any kind of time series, the basic objective is to achieve parsimony. Right? Parsimony means the model should be as small as possible. Right? As small as possible. For example, if we get a better model with AR1, then it will be the smallest possible model we can have. So if I'm able to capture all the time series behavior and dynamics within this AR1 model, then yes, I need not go for higher order models. Suppose you identify a lag of say 15 or you identify a lag of 20. So you have to go up to 15th lag or 20th lag to capture the dynamics of the time series. So 15 lag is too long a model for you to make any meaningful interpretations, right? Which in time series we must avoid because they do not convey any kind of messages, right? Especially when we are talking about market efficiency, right? Market is efficient, we talk about that. So if you take lags up to 20th lag or 15 lags, so that may not have any economic significance. Mathematically, yes, you can do the model, but they may not have any economic significance, right? Especially when I'm saying that my market is efficient. So what has happened in some 20 days back may not have any relevance today, right? So keeping those concepts in mind, so we need to search for that model which is parsimonious, as small as possible, and which is able to predict my returns with some degree of efficiency. In simple words, after you fit the model, your residual term, this should not be able to explain your YT. That means your residual term should not affect your YT. In essence, you are saying that yes, if my residual is affecting my YT, you are saying that yes, residual is correlated or there is an autocorrelation present, which I don't want. That means if my model is good, all the explanations should happen from the model itself, not from the error term. Right? Error term is the unexplanatory part, which we don't want. So my model has to be robust in a sense that whatever I have fitted, whatever lag I have selected, that lag should be able to, or that model should be able to predict the returns. So that means those lags should contain all the information that is required for predictions, not the error term. So that is the basic concept in AR models, right? So how do we identify the lags? So lag identification. There are three methods we can use to start with. First one is called as PACF method, AIC method, and FQ method. This is basically partial autocorrelation function. This one is Akaike information criteria. Information criteria. This is Bayes information criteria. And this one is Hannan Quinn criteria. Right? So lag identification for AR models. So we can use these. So these are collectively called as information criteria. All these are collectively called as information criteria. Right? This is basically a plot. So you can say this is a visual identification of the flags, whereas the remaining three are basically based on statistical measurement, likelihood functions. So let us understand these first, and then we will implement. Okay, just note down if you are doing that, and let me know if you are done with that. Partial autocorrelation function, AIC, BIC, and Hannan Quinn criteria.
Sir,
Yes.
you have written that these four are the methods for just for ARP models. So
No, to identify the lags.
to identify the lags for ARP models.
Right, right.
So there are different methods for different models for lag identifications.
Yes, for MA model, that lag identification methods are similar to this one. That also we will discuss, but they are similar to this one only. For ARMA,
Continuous.
So right. So for all the three models, you have three different mechanisms, but they are very closely related. So in all the three methods, what you will observe that information criteria is the same.
Yes,
They
sir.
are common to all the three methods, but what will change is the visual plots. The ACF, the PACF, and in ARMA, we'll talking about the EACF. That is the only change in the lag identification techniques.
So if we talk about VAR models or VECM, then there are only these three information criteria.
Right, right, right. Okay. So let's first understand what is PACF doing. Let me write an equation. yt is equal to alpha plus alpha 0 plus alpha 1 yt minus 1 plus error term. Let me write another equation. This is AR1 model. Let me write AR2 model. Alpha 1 it is. Plus error term. Let me take AR3 model also. Plus alpha 2 yt minus 2 plus alpha 3 yt minus 3 plus error term. And likewise we can continue. So yt up to the pth lag alpha p yt minus p plus error term. Now basically this is a stepwise regression you are trying to do. First you have included in the model first lag, the second lag, the third lag, and you have included the fourth lag. Now have these coefficients with you. This one is available to you, this one is available to you, this one is available to you, and this one is also available to you. So these coefficients are called as PSEFs. They are called as partial autocorrelation functions. And we need to identify that. So this will help us to identify the lag, right? So this is the basic idea about the PSEF. PSEF is basically the coefficients of each incremental lag that is you are including in the model, right? Regression model. So when this can be done in Excel also, right? It's very easy to do that. So what we'll do, what we'll be getting rather is that a graph something like this. On this we'll be getting the lags, and here we'll be getting the PSEFs. And these two lines will be getting, and somewhat similar to this one you'll be also getting. Somewhere here like this, somewhere here like this, right? So, and you may get a figure like this. So this is lag number 1, lag number 2, lag number 3, lag number 4, 5, and you continue, right? These horizontal blue color lines which you are able to see, they are called as confidence intervals. Right? They are called as confidence intervals. And this is calculated as plus minus z divided by square root of t, where t is the length of the series, what are your time series. And the value of z at 5% is equal to 1.96, and at 1% it is equal to 1.64. So suppose you are testing your hypothesis, or you are doing the PSEF for 5% at 5%. So what you will do? You will plus minus 1.96 divided by square root of t in this case, which is t is the number of observation. That also is available to us. So manually also you can calculate this, right? So these confidence intervals are important for us. Now what happens that you have to identify those bars which are intersecting these confidence lines on either side. This one, and this one. Right? And you have to identify the respective lags. So that means here, first case is intersecting, the third case is intersecting, and the fifth case is also intersecting. That means PSEF is suggesting a lag of 1, 3, and 5. Right? So it has suggested that, okay, you include either 1, 3, or 5, or you include all of them. 5 will be a big model, so we can restrict ourselves to 1 and 3 in this case. Right? So this is how we need to identify the lag as suggested by the PSEF. Is it clear?
Yes, sir. But can you show this through the Excel or R Studio?
In Excel, it will take time. Unnecessary. So why to do that? I mean, that you can do manually also. It's very easy to do that. I will just tell you the methodology what you can do, because it will consume a lot of your time. So suppose you have a time series here, right? And let us say you have created one time series here. So first you have to calculate the returns as usual. So returns, it is equal to this divided by this one, right? So something like this you have to do first. So this is your YT. This is my YT. It means the first thing that you have to do is to calculate YT minus 1. So YT minus 1 means this figure has to appear here. This one. Like this. And you drag it. Similarly, you have YT minus 2. What you will do here? Minus 2 means here the first figure should appear. This one. And then you drag it. Are you getting the point?
Yes, sir.
Then what you have to do, first calculate alpha 1, which is basically the correlation between these two numbers. This series and this series first. What you will do, so correlation, let me plot at lag 1. Lag 1, the correlation you have to first calculate. So correlation between this series and correlation between this series. No, it should not be 1. It's t minus 1 is here. Okay. ठीक है, is equal to correl. This data set you have to take, comma, this data set you have to take. So some correlation you are getting here. Similarly, for lag 2, you will be getting certain correlation again, right? So lag 2 means between this and this one, right? So this one, comma, this one, right? So lag 2 correlation you have identified. So this is minus 0.66, this is 0.10, and if you want to calculate the Z statistics, what you will do? It is equal to, so the upper interval will be equal to what? Upper confidence interval and the lower confidence interval. So upper is equal to plus 1.96 divided by length of the series. So how many observations are there here? 11. This is equal to 1.96 divided by square root of 11. This becomes your confidence interval on the upper side. Right, on the lower side, it will be equal to minus 1.96 or minus of this number. The same value will come. Yeah, ये दो आपका confidence interval बन गया, minus 0.59 and minus 0.59. So what is, it will cross the this figure. आपका value कितना आ रहा है? 0.166, right?
Yes, sir.
तो इसमें जब आप plotting करेंगे हम उसमें आएगा. Because my confidence interval is 0.55 plus and 0.55 minus, and it is getting my 0.9. So somewhere it will, the first lag value will be 0.66 minus 0.66. it will cross this. It is at lag number 1, I have crossed the confidence interval. So that means for you, you can identify lag number 1. Right?
Yes, sir. Good.
So the same thing you continue and you will be able to plot for all the lags. Right? So this is the mechanism, but it's good that you asked so that at least you know the algorithm also at the what is happening in the background. Okay. So that is the concept that we are talking about. So we need to first identify those PSCFs which are intersecting the horizontal axis, the confidence intervals on either side, and they will be my lags. So let us do this for your NTPC return. Well, here you can write AR modeling. And first is lag identification using PSCF. Right? Okay, are you ready with this?
Yes, sir.
Yes, sir.
Okay, great. We will require another library for this, which is called a forecast. Library forecast. This one. So please install it. Please let me know when you are ready with this library.
Done, sir.
Done?
Yes.
Okay. Others? Okay, there is a message.
Sir, it's
Okay.
4 cats.
Sorry? हाँ मैडम कुछ बोल रही थी आप?
Sir, it's 4 cats, not forecast.
Huh? No, forecast you have to install. So go to this one and then you can type it here, forecast. This one, the first option. Dr. Vemuri, I think you are not getting it. It is available in CRAN website. So what you do, just type it on your own in this package window, all in small letters, and then install. Let's try that way. Maybe because of slow internet connection, you are not able to get, because for installation of libraries, you require a good internet speed. Got it. Very nice. Others, have you got this?
Yes, yes.
Okay. Madam, आपका?
Yeah, I've got it. Thank you.
Okay, great. Seema, Harsh?
Yes, sir, done.
Okay. I think Seema is not able to attend again today. She has some engagements in the class. Okay, let us proceed then. So what you have to type it first, you type PSCF, that's all. NTPC return and lag.max is equal to, type it say 20. This 20 is not sacrosanct. You can type 10 also, 15 also. It's up to you. And let's plot this graph. So go ahead with, let's go ahead with 20. So this graph you will be able to get. Are you able to get this plot, PSCF?
Yes, sir.
Okay. So let's conclude this graph first. Let's analyze. So which lag you are able to identify? Identify that spike which is intersecting the horizontal lines, the blue color lines, which is the confidence interval. So in our case, what you are observing? Lag number 6, right? This one. Check your graph also. This is the only value which is intersecting of the PSCF. Have you identified? Lag number 6 and lag number 19 also, but lag number 19 is too high, so we can ignore this. So we can consider lag number 6, although it is also very high, but still let's see. Have you identified this?
Yes, sir.
Let's note down somewhere that for NTPC, and for Bajaj, for JP Morgan, and for Boeing, so method of PSCF is suggesting a lag of 6. So this we can note down. So can you quickly tell me what is the lag you're getting for Bajaj return, so that I can note down?
Sir, for Bajaj return, lag number 5 to 8, all the 4 lags are crossing the confidence interval.
What PSCF for?
For Bajaj return.
Okay, how much you're getting?
So lag number 5th, 6th, 7th, and 8th, all these 4 lags are crossing the confidence intervals.
Right. Let me just check again. See the graph you're getting?
Yes, sir.
So lag number 5, you can identify clearly. 5, 6, 7, 8. Isn't it? Higher lags we can ignore. So lag number 5 you are able to identify. This one. And lag number 6 also. So let's note down lag number 5 and lag number 6. 7 is also there, but it's also higher order, so we can ignore that. 5 and 6 we can consider for Bajaj. So for Bajaj, we have identified lag number 5 and 6. Similarly for JP Morgan and Boeing. Okay, let's do one thing. JP Morgan and Boeing we can do a bit later after we complete NTPC and Bajaj, right? So that that will be a practice for you. So we have identified lag number 6 for NTPC and lag number 5 and 6 for Bajaj under the PACF method. Now we are to deal with the remaining two. HQ method we will not do. It's not very important. AIC is most important of all. AIC and BIC. So let's do that first. Based on information criteria. Right? Based on information criteria. So what are the information criteria we are using? So we are using the AIC and BIC, right? So first you write auto.arima. This function is under liability forecast. So you have to run this liability first. Then you type NTPC underscore ret max dot is equal to 10. I will tell you what these values are. Max dot q is equal to 0. Max dot d is equal to 0. And IC equals AIC.
Which library did we have to run? Sorry.
Forecast. This one.
Okay. Okay.
Yeah.
It's okay.
Just complete this. I'm sharing this in a chat box. You can copy it from there also. Let me know when you are done.
Yes, sir. Done.
Okay. Others, I hope you are done with this part.
Yeah.
Okay. Okay. So now let me tell you why I have written max dot p is equal to 10 and others are 0. Right. So this is basically a syntax we use in R. So let me tell you. Basically, this function is used for ARIMA model. Right. Auto-regressive integrated moving average. You might have come across this model many a times. So this is basically P, D, and Q we write. Right. For this term, AR, this P is used. I stands for this D, and this MA gives you this particular Q. Right. So this P and Q we have already written. D is basically for the integrated model. Now, if I am right, because since we are working in this D, you can say it is basically the differencing part. Which pertains or corresponds to this I. Right. So since in our case, we have already taken the return, and return is basically already differenced. It is the difference of price. That means differencing has already been done for the return series. That means we don't want any further differencing for this. That's why this by default every time D has to be 0 in all the models. Right? So that is why D will always be 0. Max dot P I have written as 10. That means I want to test under AIC method up to 10th leg. Up to 10th leg. Then I have written max dot D is equal to 0 because I told you this differencing is not required here. And max dot Q is equal to also 0 I've written because this model pertains to the MA model and we are doing AR model right now. So that's why you have to define it by 0. Right? And when we do MA model, what will be our code? Max dot P will be equal to 0. Max dot D will also be equal to 0. Max dot Q will be equal to 10. So when you're defining this Q, you are saying that I am doing a MA model. When I'm defining this P, you are saying that I am doing an AR model. Right? So that is why these parameters need to be written in that syntax. Am I clear? This is basically regarding the syntax only, right? So that's the question, it seems. Okay. Okay. So this is clear, this syntax.
Yes.
Okay. And let's run this first. AIC you have already defined, right? So this is under AIC criteria, we are identifying the lag. So let us run this. And this will give you the lag. That means AIC is not suggesting any lag. So AIC is basically suggesting a random walk for this model. Right? No lag is suggested under AIC. So let us see what is there in BIC. Just copy this. Everything else remaining same, only AIC has to be changed to BIC. That's all. How much BIC is suggesting? BIC is also not suggesting any lag. Right? So from here you can identify. So we can note down here in our model. AIC is not suggesting any lag. BIC is also not suggesting any lag for NTPC. Can you identify for Bajaj and tell me what is the AIC?
So no lags are suggested.
Okay, in ASC and BSc both?
Oh, yes, sir. In both.
Okay, right. Okay, others can also verify. Okay. BIC is very simple. I mean, instead of AIC, you just have to replace that AIC with BIC. That's all. Everything else remaining same. Are you done with this part?
Yes.
So we have identified certain lags using all the methods. So for NTPC, now whenever you identify these lags, right, always start with the least possible lag. Except 0. Right, 0 has not to be considered. For example, in case of NTPC, we got only 1 lag. 6 has to be the preference. But in case of Bajaj, we are getting lag number 5 and 6. That means when we start the model, we have to consider first lag number 5. Then fit the model, do the testing. If the model is not appropriate, then we have to go for higher orders. Right? So you always have to start with the least possible suggested lag. Then we need to fit that model using that lag, and then you need to test it. Right? Because my objective is to have a small as possible model, parsimonious. Right? So that is the step you need to remember. Since we have identified lag number 6 in case of NTPC, let us first fit this model. What you have to do, let me give a name, say output underscore NTPC. Underscore AR, because it's an AR model we are doing. Then you write ARIMA NTPC return. Right, NTPC return. And we have identified lag number 6, so we have to write like this. So 0, C 6, 0, 0. The first number pertains to AR. Second number stands for I, and the third number is for MA. So since we are not doing I part or we are not doing MA part, that's why I have kept it as 0. And finally, I want the constant term to be there reported. So write true. Team is true here. That means I want the mean value to be reported in my result. Just complete this. So what this command is trying to do, it is now fitting the model up to 6 lakhs, including the average, yeah, including the mean value, right? So are you done with this part? Let's run this first.
Done, sir.
Done? Others?
Yes, sir, done.
Okay. So now you want to see the results. So you type summary and the variable output underscore NTPC, this one. So the output also you can get. You see there are 7 parameters reported, right? 6 lakhs and 1 intercept, 1 constant term. Are you getting this result? Just check.
Yes, sir.
Okay. Fine. So this is how we fit the model. And in the case of NTPC, what we have done, we have identified only lag number 6, right? Only lag number 6 we have identified. That means we are not interested in lag number 1, 2, 3, 4, and 5 because they have not been suggested. So our focus will therefore only be on AR6. AR6 means autoregressive term, the 6th term. So we need to identify whether that coefficient is significant or not. Values we have got, but I need to first kind of find out what is the statistical significance of that variable. So you have to now find out this AR6 number, right? So coefficient is minus 0.0831. So let's write it somewhere here. So the coefficient of AR6 is equal to minus 0.0831. This is the coefficient. And the standard error of this number is how much? 0.023. It's written here. AC means the standard error. This one. Right? So this one is my standard error. So this number you have to find out. So 0.023, let's note down, is my standard error. So 0.023. And T statistics you can also calculate, which is equal to the coefficient divided by the standard error, which is equal to minus 0.0831 divided by 0.023. So it is approximately equal to minus, how much will it be? 0.0831 divided by 0.023. It is 3.61. It is 3.61. Since it is more than 1.96 at 5%, right? Absolute value you have to take, obviously, the absolute value. So that means we say that this coefficient is statistically significant. That means AR6, the sixth lag is important for NTPC's return to be included in the model. So we have found out the statistical significance also. If it is not found to be statistically significant, then obviously we cannot include that in our model, right? So after you have fitted the model, you have to test it first using the T-stat, the statistical significance, and then you come to a conclusion that yes, economically also it is, statistically also it is significant. Okay, so other lags we can ignore. Okay, this part is clear. How to calculate the statistical significance?
Yes, sir.
Okay. Now, as usual, I told you the next step. So we have fitted the model, right? So we have to now test two things. First, stationarity of the coefficient we have calculated, AR6 coefficient, and box test or autocorrelation test. Autocorrelation test of residuals. Right, so these two tests now we need to do. So model we have fitted, that's fine. But whether the model is good or not, how do we know? So these two tests you have to do first to identify the stationarity of the residual.
Shantanu, sorry.
Yeah.
Sorry. Can you just show the previous one, the interpretation one? Yeah.
Okay.
Yeah.
Yes, so just, it is.
So it worked out to 3.61, right? That's what.
Absolute value is 3.61. Yes, since it is more than 1.96, 5%. So
Okay,
our null hypothesis is that coefficient is not significant.
Okay. Yeah. Go ahead.
So since it is more than, so you are rejecting null.
Yeah.
And you're saying that this coefficient is statistically significant. And that is what we want also, right? Since we have identified lag number 6 for NTPC.
Correct.
So this statistical significance is satisfied. Now you need to now do these two tests also additionally. First is the stationarity of the coefficient. The coefficient that I found, minus 0.0831. Is it stable or not? Right? Because if it is not stable, then obviously I cannot use it for prediction purpose, because coefficient itself is not stable. That means it will give you different values under different conditions, which we don't want. That means if your model has to be good, this coefficient also needs to be stationary. That is the first part. Second part, your overall model that you fitted, whether that can be used for prediction purpose, yes or no. So how do we know that? We have to do the residual testing, autocorrelation testing on the residuals. So these two additional tests you have to do. So for efficient stationarity, let's write that first. Let me write, give a name, say NTPC underscore stationarity test is equal to write C 1 comma, right? These are by default, you have to try it every time, so nothing to worry about that. Output we have just find out, press a $sign, select the coefficient, and give one is true, 2. Right? So basically this is to set up the polynomial. This is by default, this command will be remaining constant for all the models that you're going for. So this is a generic command to set up the polynomial. And let me write R1. I need to find out the unit root, because stationarity test we are doing. You have to write polynomial root of NTPC stat test. Oh, it is polyroot. Polyroot. Okay. You can just check what we are getting. Okay, these two values. Then root 1 is equal to mod the modulus Okay, I am just giving you these commands. We'll write the interpretation part only. By default will remain the same. The only thing, the variable name only you have to change. That's all. This is for stationarity testing of the coefficient. So please copy it from the chat box. So how do I interpret the results? The characteristic root must be less than 0 for stationarity of coefficients. So this we have to check whether my characteristic root should be less than 0. Basically, unit root we are trying to find out, right? So this you have to check whether it is less than 0 or not. So try to identify. Now, since in both the cases they are more than 0, so obviously the coefficient is not stationary in this case. Are you getting the same results? Just check. Characteristic root I'm getting 0.103 and 0.083.
Yes, sir, getting the same result.
Same values. So since they are greater than 0, so we conclude that yes, although the coefficient is statistically significant, but it is not stable. Right? So prediction will be very difficult and we may not get a correct output out of this model. So this is the first part. Second part is the box test, autocorrelation test of the residual that you know. So let's do that first. Box test of the residuals, right? So I have set my output somewhere in tpc.ar. Press the $sign and here you get the residuals. And lag is equal to maybe up to 10th lag you can test, and type is equal to Ljung box. That's all. Just identify what is the box results, autocorrelation result.
There is no autocorrelation.
There is a disturbance going on. I will just get back to you in another 1 minute or so. Please wait. Okay, so yeah, so I think the disturbance is now gone. So let's do one thing. Let's meet at 2 p.m. After your lunch. But in the meantime, before that, just run this line. I mean, have you done this for the residuals part?
Yeah, we've done it.
So probability value, how much we are getting? 0.78, right?
Yeah.
So that means you need to accept the null in this case. And I told you that for the residuals, there must not be any autocorrelation, right? And the null hypothesis is that there is no autocorrelation. So that means your model is perfect. As the entire model is okay because there is no autocorrelation in the residual terms. right? So, and that is what we desired for. But the problem is with respect to the stationarity of the coefficients, right? But still, if you want, we can use this particular model. But since it is a very long model, so 6 lakhs is a very huge model. Maybe after we come back, we will go ahead with MA model and ARMA model. Let's try to find out whether AR and MA model, MA and ARMA model are suitable for NTPC. So for NTPC, we have identified that AR model is, we have identified lag number 6, right? Lag number 6 we have identified, and we have done some testing. And based on those tests, you say that yes, there is no autocorrelation in the residual terms. So model wise, it is okay, but there is no stability in the coefficients, right? So which makes our prediction very uncertain. So up to this point, I hope it is clear.
Yes, sir.
Okay, great. So it's already 1:10. I think let's take a break of 10 minutes. Sorry, let's take a break and let's meet at 2 p.m. Will that be okay?
Yes, sir.
Yeah, that's right.
Right. So let's meet at 2 p.m. and we'll discuss some more issues with this model, AR model. We'll also go for forecasting prediction, and then we will refine this model, right? Okay, chaliye, let's have the lunch and let's come back at 2 p.m. Okay, so good afternoon. So I hope all of you have joined. I think two are yet to join. Okay. Okay, let's wait for another 2-3 minutes. In the meantime, we can discuss some questions, if any.
Sir, can you please explain what has to be done for that the project that you were saying?
Okay. See, basically, we want that whatever you are learning here, you are able to do this on an independent basis. Suppose you were to write a research paper or you want to do some project. So this basically is the thought process is that the participants, whoever is coming, has he or she learned the concepts well or not? And doing in the class is one thing, right? But doing it independently is another thing. So it is possible that when you do it independently outside the classroom, you may face some of the problems, you may encounter some issues, either in the commands or in the concept. Then we want you to come with those problems and issues in the classroom back.
Okay.
So that we can discuss and other participants can also come to know that, okay, if this is the issue, this is how it has to be dealt with.
Okay, got it.
So just identify 4 or 5 assets and do an analysis of whatever we are doing. It's not
Okay.
outside anything you have to do.
Mhm.
Whatever we are doing, just do normality test, Jarkevera, do autocorrelation test, ADF test, you do AR model, MA model. You try to fit and discuss your problems, discuss your issues and output, right? So that will help us to also search for some possibilities about collaborations for future research also. So
Got
that
it.
is another objective.
Mhm.
So it is basically to give you an opportunity to explore your own learning in these 4 days. That's all.
Okay. And when do we have to submit or present?
No, it's not a presentation. I mean, you will come out with your output in a Word file maybe, or in a PPT if you want. So whatever it's convenient to you,
Okay.
just bring it on the last day. We will have that. I think we'll try to finish it, the lectures by 2 p.m. or so.
Okay.
And maybe after 2:30 for half an hour, we'll meet. 3 groups are there, 10 minutes each. We can discuss.
Okay.
So that's will be fine.
Done. Any
So there is,
4 or 5 stocks that we can take note.
as per your
Okay.
choice, there is no
Okay.
restriction on that. Just have to apply whatever you're learning.
Got it. Got it.
That's all. That's all.
Okay. Done. Thank you.
That we can download the data from Yahoo Finance like we are doing here in class.
Yes. You can download it from Yahoo Finance, or if you are willing to work in bonds or something like that, cryptocurrencies, then you can do it from either Bloomberg terminals or investing.com is also there, from where you can download good quality data. If you're working in economics area, maybe inflation, repo rates, right? Interest rates, for example, unemployment. So for that, you can go to, I think St. Louis Federal Bank is there. Very good quality data you'll be able to get from there. Right. So, so that also you can use.
Yahoo Finance, we just directly copy paste it and we get the data.
In R is compatible with both Yahoo Finance and Bloomberg terminals.
Okay.
So if you want to fetch the live data, you can do it from Yahoo Finance directly.
But if we are getting it from St. Louis, then we have to compile it in one file.
Yeah, so then you can use a cbind function, column bind.
Okay. And then import the data.
Then you proceed as per whatever we are doing. Preferably, if you make a practice that, okay, suppose you are calculating the ADF, you are calculating the autocorrelation test. Make it in a tabular format, as if you are submitting in a research journal. So that will also help you to format and to report the results. That also you can do. Okay, anything else or let's I think start.
Sir, sorry, one more question.
Yeah, please.
If we wanted to, let's say, extract data from directly, let's say from NSE or BSE website.
Okay,
so
no,
ideally
R is not compatible with those websites.
Okay, so first I'll copy in Excel and then put it in
yes.
done. Okay, thank you.
Okay, so this is what we have so far. You have done a box test also on the residuals, right? So let me revisit that. Okay. So, right. So we are getting a p-value of 0.96, right, in this case. So my conclusion is that there is no autocorrelation in the residual term. That means my model is good. The overall model is good, right? So that is what we wanted. So you need to just check these two things. Autocorrelation must be present in the returns for you to proceed. And when you fit the model, there must not be any autocorrelation in the residual term. So this is what we have done so far. Right. So let me tell you some more aspects of this modeling part. Now, in this case, what happens that in this particular model, our interest lies only in the sixth lag, right? What is happening here, if you see, if you run these two lines, all the 5 lakhs are also getting reported simultaneously, right? Which we don't want. I don't want these AR1, AR2, AR5, AR4 to be reported. I want only these two values to be reported, AR6 and intercept term, right? So that can also be done. So for that, you have to just tweak model, maybe like this. So you can write output 2/4 NTPC, maybe you can write like RIMA, then NTPC return, and order. Order means up to how many lakhs I want. So as per the place here, we identify 6 lakhs. So I have to write 6,0,0. And then you have to fix. So I don't want to report all the coefficients. I want only the 6th lakh to be reported. Right. So what you have to do in this, but this is the additional thing that you can write. So fixed C is the concatenation function. I don't want AR1, so write 0. I don't want AR2, so write 0. I don't want AR3, again write 0. I don't want AR4, again 0. I don't want 5, 0. But I want 6. I want the 6th coefficient, 6th lag to be reported. So write NA here. Right? And finally, I also want the intercept to be reported. So again, write NA. So the last NA is always for the intercept term. So this is the only change you have to make in your modeling. Just complete this. And I have stored it in a new variable so that we don't overwrite the previous result. Let's execute this. And here you write summary. Of that variable output underscore to NTP, this one. Okay, so this way you can remove all the undesired variables. So you can check your output also. Let me know when you're done with this part.
Yeah.
Okay, so are you able to locate these result now like this?
No, I'm getting an error. Can I just share my
Acha.
screen, please?
Sure.
Yeah.
That seems to be fine. Order is equal to 6 comma you have written, or what it is?
Yeah,
Or
6
dot?
comma.
It is dot,
Comma.
I suppose. No, 6 comma or dot it is. I think dot.
Oh, okay,
Now
let me
you run
run
this.
No. 6 comma.
Okay. Now run this.
Yeah, I did. It's again error. Sorry.
Again error?
Yeah.
Okay.
Do you think I need to run one of the packages again?
Not required. Not required in this case. Output to NTPC is equal to ARIMA NTPC return. Fixed is equal to 1, 2, 3, 4, 5, 6, 7. 2, 3, 4, 5, 6, 7. That's okay.
Arima stacks,
Okay.
right?
No.
Yeah.
Order is equal to C you have to give, right? Small c outside the bracket. Now run this. Now summary output 2.
Okay, fair. I'll confuse.
Now it should run. Okay, so this way you can remove your undesired variables, right? And you can do a box test on this. You should be getting the same. You check coefficient. Coefficient has not changed from the previous model. So that is what is important to note. In the last case also we got the same value, coefficient and the standard error. This time also we are getting the same, right? Okay. And these values are also important for us to note down, right? Especially RMSE and mean average error term, right? These two values we should note down. RMSE means root mean squared error. and MA is mean absolute error. So when we compare, now we are going for MA model. So for NTPC, we will fit the MA model. Now, which model I should pick up? Whether I should pick up MA, I should pick up AR, or I should pick up ARMA model for NTPC? And that is the question that you have to answer, right? So in that case, you have to select this RMSE or MAE will come to your rescue. That means you have to pick that model which is giving you the least value of RMSE or mean absolute error. So whichever method or whichever model is giving you these two, either of these two is least, that model has to be used for prediction. Right? So that is the idea in this modeling part. Right? So this we have done. So you can do a box test also finally. It will give you the same result. So output 2 of NTPC and type is equal to box. What happened? Okay. The residuals. So my value is 41.8% p-value. So here you accept, right? Here also the same interpretation. So that means there is no autocorrelation in the residual terms. So we suggest that your model is good. Right? So this is how we can do. And finally, once you are satisfied that your model is good, we can use it for prediction purpose. So the command is predict. Output NTPC. And say for the next 10 days, I want to make predictions. So it has given you this particular prediction. Right? So next 10 days prediction also is possible. Or 5 days if you want to do it for 5 days only. So that 5 you write and it will do the prediction for 5 days. So this is a prediction of the return, daily returns. So it is suggesting that yes, in the 4th and 5th day, you are likely to get a negative return.
Shantanu, this hadn't been decided that it's not stable, but this model.
Yes, yes. I mean,
or am I missing out? Okay, fair.
Right. We have done a stationarity test on the coefficient, right? And we identified that the coefficient is not a stable coefficient. But the question is that in these kind of models, right, we are not too much concerned about the stability part because we are not going for a long-term predictions.
Okay.
So that part we can ignore. But you have to be satisfied with the second test, especially that is residual test.
Okay.
If there is an autocorrelation in the residual, then there is a problem. Plotting of forecast. Okay. I haven't done that. Let me just try. Let me store it in a value to predict. Plot. Yes, so this prediction is possible, fairly possible. So this is what the graph will look like. It's a 5-day prediction only. So maybe you would like to do for 10 So this is the 10 days prediction. So this also you can do, right? So since these are very only 5 or 6 observations are there, so plotting is okay if you want to do that. So you can go ahead with that, but it's not very much required. Okay, so should I proceed to the next part? If you're ready.
Yeah, go ahead.
Okay. So the next part that we are going to talk about is the MA model, moving average model, right? So this model is also pretty simple in the sense that it is similar to autoregressive models, but the difference is that in case of moving average, this model is basically MAQ model. So the returns are regressed upon past error terms, right? It is regressed upon the past error terms. Now, for example, how does it work? Suppose let me write two equations, alpha 0 plus alpha 1 yt minus 1 plus say alpha 1 t I am writing, right? Just for separation purpose, alpha 1 t. This is the first model. Let me write another flag here, alpha 0 plus alpha 1 yt minus 1 plus alpha 2 yt minus 2 plus the second error term, right? So what I'm saying is that here I should write 1 and here let me write 2, just to differentiate that this is the first regression, this is the second regression. Now what is happening here is that suppose I want to predict this, but I want to model this one, y2t. It says that it is a function of beta 0 plus beta 1 t. That means this return, today's return is based on its previous day's error term. So this error term will be an input here, plus error term for this particular regression, right? Similarly, if you have y3t, if you add another term, it will be equal to beta 0 plus beta 1 t plus beta 2 sigma 2t plus the error term of that particular series. That means these error terms from the previous regression becomes your independent variable for the next regression. So when the return series is regressed upon its past error terms, right? These are my error terms, past error terms. These kind of models are called as MA models. Right? So these kind of models will be called as MA models. So in practice or in representation term, we write like this: y3 is equal to say alpha 0 plus alpha 1 error term minus 1 plus alpha 2 error term t minus 2 plus it will continue alpha q epsilon t minus q plus the error term of that particular series, right? Now the question is, where this term is coming from. This term is coming from the first regression, right? Which is a part of, which becomes a basis for the next your autoregressive model here. But how do we estimate this error term? This error term cannot be estimated unless and until this one is executed, y1t. And MA model says that y1t is based on its the yesterday's return. So there has to be an error term here also, right? That means you cannot predict or you cannot estimate today's return unless and until you have yesterday's error term. And yesterday's error term is not possible unless and until you have that regression for that particular day. That means this chain will continue, and it is not possible for you to directly estimate this error term just like doing a regression, because error term is not known to us initially. So in that case, we have to use the concept of maximum likelihood method, right? So these estimates, these error terms are estimated using the maximum likelihood method, which we discussed yesterday. Estimation or MLE estimations, right? So that is the basic logic in an MA model, right? Is it clear? Okay. So let me write now, let's understand the relationship between AR model and MA model, right? So let me first write an AR1 model. So how we can write? So YT is equal to function of say beta 1 YT minus 1 plus the error term. I'm ignoring the constant term as of now. So let it be equation number 1. So this is my AR1 model, right? So if I want to write YT minus 1, how can I write this? Beta 1 into YT minus 2 plus the error term T minus 1. Can I write like this? This is also an AR1 model. Just see the equation. So I have written two AR1 models, but we're using two different lags. Can I write like this?
Yes, sir.
So let's substitute 2 in 1. What I will be getting? YT should be equal to this beta 1 is constant. Instead of YT minus 1, what we can write? Beta 1 YT minus 2 plus error term plus the error term of that one. Check. Can I write like this? So it becomes equal to beta 1 square YT minus 1 T minus 2 plus beta 1 T minus 1 plus error term. Okay? Can I write like this? So let's rearrange this. This error term plus beta 1 error T minus 1 plus beta 1 square into YT minus 2. I can, after rearrangement, we can write like this. Okay. And if I continue with this particular series, see here what we are getting. Here error 1, error t minus 1. Now this can also be replaced. So if you go to infinite series, ultimately it gets transformed into error term only. Right? So ultimately what we are going to get is that this AR1 model is nothing but it is equivalent to, so this can go up to infinite values. Right? So that means we can go up till t minus infinite terms. Right? Up to t minus infinite lags we can go up to. So we suggest, and all ultimately your equation will be based on yt should be dependent on all the error terms only up to infinite terms. So which means that the AR1 model is nothing but it is equivalent to MA infinite model. Right? So what is happening here is basically that in AR1 model is more parsimonious in the sense that only one parameter will explain the infinite models of an MA model. So instead of going for infinite parameters in MA, you just estimate only one parameter in AR model. That is what it is saying. So if you compare these two models, it is saying that the theory says that yes, AR model is more parsimonious as compared to the MA model. Right. So that is basically the relationship. Right. So I hope I am clear.
So could you please explain the last step?
See this one, you go for repeated substitutions. In yt minus 2, what I can write? You extend this equation. Can I write like this? Yt minus 2. Can I write like this? So beta 1 again.
Yt minus 3. Yes, sir.
Plus the error term.
Yes, sir.
So if I replace this yt minus 2 in that equation, so yt minus 3 will be generated.
Yes, sir. And et minus 3 will also.
And
be
et
there.
will minus 3 will get generated. So that means this can be now replaced with yt minus 4.
Okay.
This will get replaced by t minus 5. Plus
Yes.
an additional error term is getting added.
Yes, sir.
So through repeated substitutions for infinite terms, ultimately you are left with only the error terms. So t minus 1, error term t minus 2, error term t minus 3, and error terms t minus infinite plus error term of that particular series. What eventually you are left with is that your return series is nothing but it is a function of my error terms only, the lagged error terms. Right. So this AR1 model is equal to now the MA infinite model. That is what it is suggesting. So this makes AR1 model to be more parsimonious as compared to your MA infinite models, right? So that is the basic theory in this model part. Is it clear now?
Yes, sir.
Great. So let us now implement that and see what kind of results we are getting for NTPC. So again, let's go back to that and copy this command. So again, you have 3 methods to identify the lag. Lag identification, in MA model. So you'll be using again 3 methods. This time it is called as ACF, then AIC, and BIC. So it is basically the auto in the past. In the AR1 model, what we have done, AR model, we have identified the partial autocorrelation, right? But here we are talking about the autocorrelation function, which is basically, it is yt is equal to, how to identify the lags here. So by t alpha 0 plus alpha 1 yt minus 1 plus alpha 2 yt minus 2, and it will continue alpha 3 yt minus 2 plus the error term of that model. These coefficients are called as ACFs. So that means in this case, you only have one equation. In the PACF, you have multiple equations. Incrementally, you are increasing and adding one lag term. Right? So these coefficients are called as my ACFs. And again, the confidence intervals, it is equal to plus minus z divided by square root of t, where z is equal to 1.96 at 5% and 1.64 at 1%. Right, so this confidence interval. So here also two parallel lines will be constructed, and we need to identify the lags based on those two horizontal lines. So let's implement that. And let's first do one thing. Here you would now IMI model. The first is lag identification using ACF. The command is very simple. You have to just type ACF NTPC underscore ret and maximum lag, let's say 20. Let's implement that. That's all. So here you will be finding one spike in the zeroth lag, right? This zeroth lag is basically the intercept term, which we are not concerned about, right? So this has to be ignored in ACF. Other than zero, you have to find that particular lag which is intersecting or touching the blue color line. So can you identify from this graph, from your graph, what is the lag you can identify?
So it's 6 again, right?
It is 6 lag again. This one. Right. So if you remember, my PSCF also identified 6 lag, and my ACF is also suggesting 6 lag. Right. So that you can note down. So somewhere in the previous cases we have identified, yes. So just like this, we can identify. So for NTPC return, NTPC, my AMA model is suggesting, for AMA model, PCF is suggesting a lag of 6. Then we have AIC and BIC. So let's identify AIC and BIC. So for that, just copy those two lines and paste it somewhere here. Everything else is same. Here you have to change max dot p, you have to make it 0 this time. And max dot q, you have to write 1, 10. Here it is 10 and here it is 0. This change only you have to make, that's all. So can you identify which lag is suggested by AIC. It is 0. It is 0. It is the same result you are getting as that in the AR model. That means both the models are suggesting you a lag of 6.
Sir,
Yeah.
so meanwhile, could you please tell me those last two commands? Actually, I was not able to join earlier.
Acha, these two you are saying?
No, sir. That predict XX is equal to predict. That,
Acha, this one.
yes, sir.
Okay. So what we have done here is basically we started in the morning. You identified 6 lag, right? So,
Yes, sir.
so we have fitted that model.
Yes, sir.
So you are getting a result like this, right?
Yes, sir.
This one. That means our interest is only on AR6.
Yes.
AR1, AR2 are also getting reported here.
Yes.
So what we have done in this command, in a new command, what we have done, we have removed those 5 regressive terms which we don't want.
Okay.
This is lag number 1. First 0 is lag number 1. This is lag number 2, lag number 3, 4, and 5. I have put 0 because I don't want the results of those 5 lags.
Yes.
I want a lag of 6, so I have written NA here.
Okay. And intercept.
And last one is intercept. I want that intercept to be reported. So I have stored that in this variable. So I have got run this line. Now you see all the values have become 0.
Yes, sir.
But this coefficient has not changed. See, from the previous result, it is the same value.
Yes, sir. Yes, sir.
Right?
Getting your point.
And we do a residual testing on this also. So we did a residual testing and we got a value of 41.8%. As you know that after you fit the model, you have to do a residual testing or autocorrelation test on the residuals.
Yes, sir. Yes, sir.
And there must not be any autocorrelation if your model has to be good. So that means you must be able to accept the null in this case. In the return, you have rejected the null.
Yes, sir.
But here you have to accept the null. And since value is more than 5%, so I am accepting the null and saying that yes, in the residual, there is no autocorrelation. That means my model is appropriate. ठीक है यहाँ तक?
Yes, sir.
So then
But
I
what
can
about
use,
the other two commands?
So these models I have used for now, we can predict.
Okay.
This is for prediction purpose.
Okay,
I have
sir.
used that model. I have found because this model is good. So I am predicting it for the say next 5 days. Return prediction. So how much return it is predicting? You can see 5 days it is making predictions of these many returns on a daily basis.
Okay.
Right. So I have made some predictions, which is my objective also. My objective of our time series model is to predict, right? I should be in a
Yes,
position
sir.
to predict. So, but
Yes,
these
sir.
are the steps that has to be you need to follow. Okay, then.
And this one is just the just plotting those predictions last.
If you want to plot something, then you can do that also.
Okay, sir. Okay,
But
thank
putting
you.
only a 5 observation will not help you. So you can skip this part.
Okay.
Okay. So this is the ACF we have done, model fitting we have done, and we similarly we have identified lag number 6 for MA model also for NTPC. So now what we need to do, we have to fit the model using lag number 6. So let me write output underscore 4 underscore NTPC, or output 3 also you can give. Two outputs we have already taken. So output number 3 NTPC is equal to. Now let us fit the model for IMA NTPC underscore and order equals to C 0,0,6. In the previous case, you had written 600 because you were doing AR model that time. But here we are doing 006 as we are fitting the MA model. And then you can write fixed is equal to C. I don't want the first. I don't want the second. Third, I don't want. Fourth, fifth, I don't want. I want the sixth, and I want the intercept. Then you can run this line. If you want to check your results, summary, output 3 NTPC. So this is the result. You can do a t-test of this coefficient and note down the RMSE and MAE. Right. So just quickly calculate, is the coefficient significant statistically? This one. So what you will do, coefficient divided by the standard error, t-test, t value will be getting. Okay, complete this in the meantime.
So it is coming out to be 3.63. That means statistically significant.
Statistically significant, yes. So your coefficient is statistically significant, and finally you have to do what? The autocorrelation test of the residuals. Finally understand whether RMSE are the same for output 2 and NTPC. Okay, great. That means we can pick any one of the models. But given the theory, you know that AR1 model can be preferred in this case if everything else is same. Although we have not done the ARMA model also, after this we'll be doing ARMA model. Then out of the 3, we'll have to select the best one. Okay, and finally, let's do the box test of the residuals. Output underscore 3 $ residuals, and type is equal to Elgin box. So you can test it whether your model is good or not. So What is your interpretation of the result? Okay, fourth decimal is different. Okay, no problem. But they are more or less same. Okay. So what is the interpretation of this number then? The box test. What is your conclusion?
So there is no autocorrelation in error terms.
Right. That means the
Residuals.
model is good or bad?
Model is fit.
Model is appropriate. That means it can be used for prediction purpose. So that also you can do. Just predict output fee, and let us predict for 5 days. So these are the predictions. It's very similar to your AR model.
Sir, can you please explain how to interpret the summary output 3?
Summary output 3. Okay, this one?
Yeah, this one.
See, I'm not concerned about the first 5 lakhs, right? So
Right.
that's why they are 0.
Right.
Now MS6, this is the coefficient, minus 0.08.
Right.
And this is the standard error.
Okay.
So I need to identify whether this coefficient which you have calculated is statistically significant or not.
Okay.
So how do I do that? So this number divided by
Divided by the
standard.
Yes. Okay.
So you will be getting the t-value test.
Right.
So since
Right.
it is approximately 3 or something like that you are getting.
Right. -3 something. Yeah.
So t-test is minus. So it is, you say that it is statistically significant. It is more than 2.
Got it. Got it.
So that means this has got some your statistical significance also.
Okay. Thank you.
So, so how do we interpret this number? So that is what we have to understand, right? And you can note down the RMSE and the MAE for MA model also. Okay. So let us do a quick exercise. Let us model AR and MA model for the remaining 3 stocks. Can you quickly do this for Bajaj, Boeing, and JP Morgan? Let us repeat the process. Let's understand. Let's do a quick practice in this session. In case you're facing an issue, let me know so that I can help you. First, you fit for Bajaj Finance, then JP Morgan, and then Boeing. Boeing return you are already having.
So what are these RMSE and MAE?
RMA, they are basically the measurement between predicted value and the forecasted value. Your predicted value and the actual value. So RMSE is root mean square error. I will write this. RMSE, it is equal to x minus, I can write, this is the actual value, this is the predicted value, maybe say x minus xi you can write, not xi. Notation थोड़ा ढूंढना दिक्कत हो जाता है कभी-कभी. Anyway.
So it could be x hat.
Let me the actual minus predicted, right? Whole divided by n. This is square. Right. So this is my RMSE, and finally we have the mean absolute error, which is equal to actual minus predicted absolute value whole divided by number of observation. So since they are talking about the difference between your prediction and the actual, so as the model is good if these values are less. If RMSE is very less or MAE is very less, that means your model is good. because it is able to predict the actual values. So for your model, these two things need to be as small as possible. Okay, am I clear?
Yes, sir.
Okay. Now do it for Bajaj Finance and JP Morgan and Boeing. Fit the appropriate models, identify the lags. Okay. Any issues with anyone?
Sir,
Yeah.
so could you show that command in which we have fixed the
Okay.
5-year terms?
Acha.
Actually, earlier in the morning session, I have done the Bajaj returns analysis side by
Acha.
side. At
This
that
one.
time, I found AR5 to be statistically significant. Coefficient
Yeah.
was not
Yeah,
stationary.
5 and 6.
I have done it only for 5, AR5.
Okay, so is the mod, so just do the testing also.
And after testing, it was rejecting the null hypothesis for residuals. So it found autocorrelation at that time.
So then you have to test for leg number 6 now.
6 also.
Yes.
But sir, I want to ask, the results may change for the residuals if we fix the terms like you have done it for 5 AR terms,
Yes.
make them 0. So
that will
change.
that will definitely change now, because in the case when you are fixing the parameter, that means you are removing the impact of the 5 variables.
Sorry, sir, you are not audible properly.
Okay, okay. No, what
now.
I'm saying is that values may change because in the second case, what you're doing, you are removing the effect of the first 5 lags, na?
Yes, sir. Yes, sir. So
that
residuals may change and it may become
that value may
significant.
change, but you have to test for the autocorrelation in any case.
Yes, sir. Okay. So you have shared that command. Okay, I will see.
It is there. Line number 363.
Yes, sir.
So it is for 6, right? So you have, so now try for 6. We are saying that 5 is autocorrelation is there.
But I have not tested it by fixing after fixing that.
Okay, do that. Okay.
Sir, the command that you have highlighted is for MA model. So it would be same for.
Yes.
So it would be same for AR model also.
No, AR model, it will be 600.
Yes, sir. But the later thing, that is the fixed.
This one will be same. This one will be same.
But I am getting error.
Error. Okay, let me see.
Okay.
Where, which line?
So this 129.
Okay. No. You have taken 5 parameters. Line number 129, you are saying, na?
Yes, sir. Yes, sir.
So you want the 5th, that seems to be okay. No problem with that.
But I'm getting this warning message.
That's fine. That's not an error. So run line number 130.
Okay.
Okay.
Thank you.
Okay. Do the your statistical significance test of the coefficient. No.
Sir,
Yes, please.
whether we have to choose AR or MA is to depend on RMSE or MEAE.
No, both of them should be give you the same interpretation.
So, like for NTPC, we run ACF, AR and MA test, both tests we ran.
So find out
So
the
how to
RMS.
decide?
No, either you focus on RMSE or MAE, any one of them.
And compare these.
Compare these two, whichever is giving you the lower RMSE, that you have to prefer.
Sir, I'm still confused. Like how to decide which is to choose, AR, MA or ARMA?
No, ARMA we have not done so far. So if you
AR and MA?
so identify that model which has got the lower RMSE. So what is the RMSE of AR model for Bajaj? For Bajaj RMSE is 0.024. Okay. For MA or AR, that.
Sir, I'm just checking.
No, I think Dr. Vemuri is replying, so I'm replying. Okay, for MA it is 0.024. So you identify that. And for AR, how much it is?
So for AR, it is also 0.0246 approx.
0.024567?
No, 2469. I'm getting 2469.
2469, right? So I mean,
For
although
AR.
that means in both the cases, RMSE is almost very close.
Yes, sir.
So you can pick any one of them. So theory says that in that case, you can prefer the your AR model.
But sir, for AR, I'm getting P value as 0.000526.
P value of what?
Bajaj Finance, AR,
For residuals.
for residuals.
Could you
That auto correlation.
Could you please repeat the value?
0.000526.
Sir,
Yes.
for JP Morgan, it is giving spikes at 1, 3, 4, 5, and 6.
Okay, so you start with 1.
Okay.
Yeah, you have to select the least possible lag.
Sir,
Yes, please go ahead.
so for Bajaj Finance, I have tested for AR5 and MA5, and both are coming to be models to be fit.
No,
So-
but in that case, RMSE, which one is lower?
Sir, both are almost same. So it's coming out to be 0.0246.
So, okay. So in that case, you can prefer AR model.
Okay, but I'm asking, should we go ahead to test AR6 and MA6 as the lags were coming out to be two values, 5 and 6?
No, it's not required because your AR5, if it is satisfying your results,
Yes,
then you
sir.
need not go for higher orders.
Okay.
That you must avoid.
And from these two, I should prefer AR model.
AR model, because everything else is same.
Yes, sir.
Suppose RMSE MA model का यदि कम होता, for example, so you could have preferred then MA model.
Sorry.
No, suppose had the RMSE of MA model been lower than AR model.
Yes, sir.
Then you should have preferred MA in that
MA
case.
model. So for JP Morgan, in case of AR model, lags are coming out to be 1 according to PACF, 2 according to AIC Akaiki, and 2 for BIC criterion.
So you start with 1.
Okay.
Yeah.
So T statistics is not significant.
अच्छा, for lag number 1.
Yes, sir. For the coefficient of lag.
Right. So then you try lag number 2.
So should I check for AR2?
AR2, but in this case, since lag 1 is also there, so you
Yes,
first
sir.
start with lag number 1 and 2 both.
Okay.
So instead of 0, 0, 0 writing, na, so you that for 1 also you write NA, for 2 also you write NA. And then you test jointly.
So 3 times NA, na, sir? First one
It is
for
3,
first leg,
including,
then second leg,
including the intercept, it is 3 NA.
So if I don't do this, I don't write fixed command. It
No,
will obviously come like this.
Right. Automatically it will come because first 2 lags only you are testing.
Yes, sir.
Yes, yes, yes. Yeah, madam, regarding your multi-unity part, I mean, I was just trying to do with one data set. So you can do that. So what we have done is I have calculated this. So these VIFs are getting reported. So that will give you the results.
Okay, so what are the commands for it? Yeah.
Okay, I will do one thing. I will just give you these. So you have to write library, then managers also. Data set. I'm just giving it to you on your chat box. So first install those 4 libraries.
Okay.
And in the library dataset that I have shared with you, na? In that dataset, there is an inbuilt dataset, empty cars karke.
Acha, okay.
So that is an inbuilt dataset, so you don't have to have. So just for practice purpose. And this, I have run a linear regression first.
Okay.
On miles per gallon. This is one dependent variable followed by all independent variables except minus VS. There is one variable there, VS. Minus VS, that it will not be considered in the regression.
Okay, right.
And then this summary I have run, and then this command you can run lastly, VIF.
Oh, okay.
So your VIF will get reported.
Okay, fair. Yeah.
Yes, so this you can try, I suppose.
Yeah. Thank you.
Yeah. Okay, so I think let's do one thing. Let's take a quick break of 15 minutes. It's I think 3:35. Maybe 3:45 we can join, and we will discuss your results, and then we'll be finally talking about the ARMA model today, right? So आप लोग थोड़ा सा चाय वगैरह पी लीजिए, because it's already, I think you have been here since morning. It must be very tough.
Sir,
Yeah, but
sir, for one lag, we will write 2 NAs.
for first leg it is 2 NAs, including the intercept.
My coefficient in standard error is coming out to be different. What is coming to be bulk?
That may happen. See, the idea is if you are removing the other coefficients, so the impact, the joint impact will be removed. So that is statistically very much possible. Yeah, so done. For Morgan, for Boeing, are you able to identify the models? Okay, so should I proceed with the ARMA model, the final model for the day? If you are able to do that. Yeah, so let me know, should I proceed?
Yeah, I think let's go ahead.
Okay, so you are able to do that independently. I am sure you are not facing any issue.
Yeah, kind of. I'm midway through it, so maybe later
Okay.
on I'll complete it.
Okay, okay. Okay, so let's complete this part and then maybe we can stop and then we can practice and try to fit the model with a new data set or the data set that you have already imported. So let us first, let's now finally talk about our next model, that is the ARMA model. So let's first talk about the concepts here. So ARMA model is basically a combination of both these two models, right? So this we have already. So by design also this model is very complicated and it is very difficult to interpret the parameters. And that is why you will see that in most of the research papers also, very, very rarely you will find that ARMA model has been reported, right? Because in most of the cases we have found that either AR or AMA model is good enough to capture and to make the model for the returns. But yes, since we are talking about the modeling part, so we can also talk about how ARMA model will look like. So let YT is a return of a series. So it is equal to alpha 0 plus alpha 1 YT minus 1 plus beta 1 error T minus 1 plus an error term. Right. So this model is called as the ARMA 1-1 model. Now, why it is ARMA 1-1? Because there is one lag of AR1 and the first lag of MA1, MA model, right? So that's why it is called as ARMA 1-1 model. So if we extend the same logic, in general, we can have this model. So alpha 0 plus alpha 1 YT minus 1 plus alpha 2 YT minus 2, and it goes continuously till pth lag YT minus P plus beta 1 T minus 1 plus beta 2 error term T minus 2, and it continues till beta Q error term T minus Q plus the error term of that particular model. So in general, we can shorten this model. Summation or T varies from, tau varies from 1 to P alpha T. Right, so this is the AR term plus tau varies from 1 to Q. Then we have beta tau epsilon T minus tau. So in general, we can write like this. Right, so as you can see, this model is basically a combination of both AR terms. So this is my AR model and this is my MA model. Right, so you have many parameters to estimate and many parameters to interpret. So you have to make estimation about the AR terms, you have to identify the lags, as well as you have to estimate and identify and interpret the lags of the error terms. Right, so that makes the model very complicated. The first step in ARMA model, as usual, is identifying the lags. Again, the lag identification. Right, so here we are going to use again 3 methods. In this case, we have ESCF, AIC, and we have BIC. This one is called as extended autocorrelation function, and these two we have already defined, right? Okay, so these 3 methods we are going to use. These 2 methods we have been doing. The new thing that we have added is the extended autocorrelation function, right? So this is unlike ACF and PCF. Here, what we are going to get is a table, right? Now, how this table will look like? You will be getting a table something like this. Here we have the AR or MA lags, and here also we have AR or MA lags. So we'll be getting something like this. right? So something like this you'll be able to get. So between 0 and cross, these two symbols you'll be able to get in the ESCF graph. This one. Now, what to do here is that we need to consider these circles, right? In the table, we need to consider these circles. And we have to find a combination of circles which will give, and you have to construct a right angle triangle using those circles like this. A right angle triangle. See, here 0 will be there, here 0 will be there, here 0 will be there. Right? So, how this triangle is to be created? So, for example, in this case, and this triangle has to be selected in such a manner that we get the maximum possible area of this triangle can be calculated, or maximum possible size, or maximum possible area, whichever way you like to look at. Right, so it means in this particular table, I have to select these dots, these circles in such a manner that I get maximum possible area of the right angle triangle. For example, in this case, I can construct a triangle something like this. If I construct a triangle like this, right? So I can get maximum possible, because otherwise, and you have to remember that in between these lines, no cross should appear. That means you cannot select a triangle like this. You cannot select a triangle like this. This green color will not be possible because your cross is there. So that means this triangle is constructed in such a manner that it only consists of those circles. That means these are basically the autocorrelation functions. And it must not have any cross in anywhere in the triangle, right? And we have to select the triangle in such a manner that we get the maximum possible area. So for example, this one we get, right? So this value, the upper corner of that particular triangle has to be considered for identifying the AR. So you have to see what is the corresponding AR term here and what is the corresponding AR term or MA term here. So if you are considering AR on the horizontal axis, that means it will be MA. If you are considering this as an MA, this has to be considered as an AR. It's up to you, right? So that means you need to see what is the corresponding AR and MA values for that, and that will be your ARMA order. So suppose you get say 0 here and 1 here, for example. So that means I can write 0 for MA and 1 for AR. So it is 1, 0, 0 like this. Or suppose you get 2 here and 3 here, for example. MA is 3. So you will be writing a ARMA 2, 0, 3 like that. So this way you have to continue and identify your lags. Right? So is it clear? I mean, what we are going to do now? Yeah, any issues in understanding this?
No, sir.
Okay, so this table is visually, this is very difficult and it is very subjective because your triangle and my triangle may differ a bit, right? Because of it's a visual inspection. So that is why, I mean, we may not completely rely on this ESCF. We have to ultimately fall on AIC and BIC. But still, let's see how we can do this. So for this, you require a library called as library TSA. This one. If you don't have this, please install it first. Let me know when you're ready with the library.
So,
Yeah.
so for JP Morgan, I have tested ER models at lag 1 and at lag 2 also.
Okay.
So I found T statistics to be insignificant in both the cases. So it was less than 1.96.
Okay.
So
Do one thing. Now you do one thing. Remove lag number 1 and only model for lag number 2.
okay.
And again test the
In case
statistical.
if it also comes to be insignificant, then
Then you have to
we
go
should
to the
move
next.
to MA models.
No, then you have to go to the next higher lag if it is suggested. After 1 to any other lag suggested?
No, sir. For PACF, it was only 1 and AIC and BIC was 2.
Okay, 2 and 2. So that means AR model is not suitable for JP Morgan in your
Yes,
case.
sir. So we should move to MA model.
MA model, yes. Okay, so are you ready with this library?
Yes, sir.
Okay. So the command is ESCF again and NTPC underscore ret. So this is what you'll be able to get. So can you identify which lag will be suitable? What best we can create? Construct the right angle triangle. From where I can start? Let me just check. I think can you start from this particular lag? Let's check. Okay, I think there is some internet issues. Then I think Dr. Memory. Okay, first you identify whether you are getting this table or not. So can we start somewhere here? Yes, what is your output?
So no, once we get the table, then what are we supposed to do? Yeah, we start correct.
Using these circles, you need to create a right angle triangle. If you start your triangle from, you see in my screen, if I start my triangle from here, right?
Correct.
So
It gets done. Yeah.
I can
from
go up
two.
to this point.
Yeah, yeah,
and
then go.
I can
Yeah,
take this
yeah.
point also, right? And then I can, so that will be the maximum possible triangle I can have.
Correct.
We suggest that this vertex has to be octet. So this vertex corresponds to 2 and 0.
Right.
Right. So this 2 is either AR or MA. You can test in both the manners.
So?
Yeah.
So at lag 1, we can also make a triangle.
No, lag 1, if you start, then only you cannot go beyond this circle. Just try, because I cannot come now. I cannot come because there's cross is there. So I cannot come down. So I will. If you start from If you start from 1, you can come down to this point.
Yes, sir.
So that is not feasible. So if you start from here 2, you can come down to at least this part.
Yes, sir.
And then if you can extend, so you can go to the next vertex is here, and then you can join this triangle. So this will be your triangle, right angle triangle. We suggest that this vertex is the most optimum for your lag. So 2 and 0. Right, so it is 2 and 0 we have identified. So 2 means you can consider either, you can consider AR2 or you can consider it as MA2, right? So both the methods we can try. So basically it is 2 and 0 is your lag that you have identified. Although it is possible to get bigger triangles here also in the higher lags, but as we have discussed that we don't go to higher lags because that will make the model very complicated. So our preference should be to find out a lag in smallest possible lags. Model as per the possible your smallest lags. So I think this, I mean, you can also identify, I mean, if I'm not able to identify correctly, maybe I'm missing something. You can check on your screen. Are you able to get a similar kind of conclusion? This is also parsimony. Yeah. That will lead to a parsimonious model if you select this one. Okay. Right. So that you can note down. So EACF is suggesting a model of 2, 0 or 0, 2. So that we have to test. Right. So let's start with this part first. So for NTPC ARMA model, so EACF is suggesting you a lag of 2, 0 or 0, 2. Then obviously we have AIC and we have BIC. So let's find out from AIC. So just copy the codes. This one. NTPC return. Now here you have to define both. P is equal to 10 and Q is equal to 10 also. Because it is an ARMA model, D by default will always be 0. Right, so this change we have to make. So let's see how much it is suggesting. It is suggesting 0, 0 and it is also suggesting 0, 0. So that means we can start with AR2 or MA2 model in this case. And let us test it. So you can give a number, say output underscore 5 underscore NTPC is equal to RIMA model fitting NTPC underscore ret and order is equal to C 2, 0, 0. We are starting with AR2 first. And then fix is equal to C. We don't want the first lag, so 0. We want the second lag and we want the intercept. So let's see what we are getting. Summary. Output 5. Okay, there are no results for this. This seems to be insignificant, the coefficient. Let us change this one now. So pharma model is not working here because the coefficients are not significant. So that means you can, for NTPC, you can either go for AR1, AR, I think 6 you have identified, and MS6 you have identified. So we can either go ahead with AR6 or MS6 for NTPC. Okay, are you getting similar results? So for NTPC, it's not working. ARMA model is not working. So maybe you can try with for other output 6. Let's do it for Bajaj return. Let's see what is the EACF of Bajaj return. Okay. Bajaj is also suggesting the same thing. 2 and 0. Just quickly do this and come to a conclusion. Can we go for ARMA for NTPC? For Bajaj also, if your ARMA is not working. Because the coefficients are not significant. So is it working for you? Are you able to fit the models? I mean, identify the lags and fitting the model? Yeah, Barkha, Ria. I mean, how far you are able to do?
Sir, please explain this order is equal to C200.
This one, right?
Yeah.
No, this we are doing for AR2 because for Bajaj also it is suggesting AR2 model or MA2 model. So I am starting with AR2 first, assuming that it is AR2 and 0, or in the next step, what you can do, you can make it 0 and make it 2 here. So that becomes ARMA 2, your MA2 model. Yes.
Okay.
So both ways you can test.
Okay.
So the triangle here in Bajaj,
Sorry?
triangle in Bajaj start what?
Yeah. No, what is Bajaj? What you're saying?
Triangle. Can we start at 1?
For Bajaj. No, if you start at 1 here, so you can go again up to maximum of this part. So that will not give you a bigger triangle, right? Only 2 circles you can include if you start at 1. But if you start at 2, you can go up to this point. So this is possible. So this way you can create a triangle. This one. So that is bigger than the previous one. If you start at 1, you can come up maximum up to this point. So your triangle is restricted only on these 3 points.
Sir,
Yeah.
so can you please show your results for Bajaj return?
Bajaj MA2 or AR2?
So for both.
Okay, for MA2, this is the result I'm getting. Here it is.
Yes, sir.
MA2 is insignificant, right? So this number divided by 0.022. It's in T statistics will be less than 1.9.
Yes, sir.
So it is insignificant. So
Yes.
ARMA model is not working for Bajaj also.
Bajaj returns also.
Right. Right. So that means you have to select from either MA or AR model for Bajaj.
Done, sir.
Okay. So similarly, you can try for the other 2 stocks, Morgan and Boeing, right? Similarly. Okay, so now we can discuss any doubts on anything from yesterday, from today, if you want any conceptual clarity.
Sir, could you please cover the topic of imputation?
Which one?
Imputation, sir.
Data imputation. Okay. Let me open a new data sheet. Let me create a matrix, say A, B, C is equal to C 1, 2, 3, 5, 7. Okay, so let me create a number series in which you have this data set in which one missing value is there, right? This is NA part. So I have done that. So if you type it ABC, you will be able to see that in the output, it is shown that the third observation is missing, right? So what you can do is, let us say I want to go for data imputation. So either instead of NA, I can insert the average value of the remaining 5 numbers, right? So for that, I need to find out what is the average of the remaining 5 numbers. So let me just try to find out mean of ABC and NA dot RM is equal to 2, for example. Right, so if I write this command, what will happen? It will calculate the mean of only the 5 numbers. It will not give you an error message, because what I have done is I have saying that don't include missing values in an average calculator. Just on your calculator, just try to find out what is the value of these mean of these 5 numbers. Can you quickly do that? We'll verify from the result. Yes, how much is your calculator giving?
Sir, it's 3.6.
That is what we have calculated, you see, in the output.
Yes, sir.
Right? So that means the third observation is missing. So, right, ABC, square bracket and 3. 3 means the third observation is equal to 3.6. And let us run this and again type ABC. You see 3.6 is now appearing in the output. Okay.
Sir, why you have written 3 in 53rd line?
Which one?
In 53rd.
This one, right?
Yes. So why you have written 3?
This one?
Yes, sir.
No, because the third observation is missing, no?
Okay, sir. But in case we have a large data,
then you have then we have to run a loop. So for that, if you can learn something about loop, then it will be easier for you to understand.
Okay.
This is just the beginning. I mean, this is the mechanism. In the loop also you have to run the same command, but loop is, I mean, a bit different in the sense that you have to start a loop and then you have to give a command that you have to look for NA values again and again, and wherever NA is found, that replace it with the average value.
Okay.
But this command will remain the same. Let me give you an example. Say C is equal to C, C maybe 1, 2, 3, NA, 10, NA, Can you replace the values NA here?
Yes, sir.
And that also you can try. So what you can do here is just run this first, then which is dot NA and XYZ. So it will give you the 4th, 6th and 7th observations are missing. Similarly, we can use median also. Yeah, if you want to replace with median. Yeah, actually, we are replacing the mean value wherever NA is there. So what it is doing, so it is calculating the average of 1, 2, 3, 11, 15 and 19, that's all. So whatever average and 10. So whatever average you are getting, that is getting replaced in these numbers, these blank cells. Yeah, everywhere the same value will get replaced. And this is called as data imputation. But it is always preferred that you replace the data with a median value rather than the average, because averages are sensitive towards presence of outliers. Right, so it is suggested that if you can go and calculate the median, then it will give you better data. Data will not be biased in that case. Yeah. Okay. Any other thing that we can discuss with reference to whatever we have discussed so far?
Sir,
Yeah.
could you say for JP Morgan's data, which lag is to be selected?
What are you saying? You want the data?
I have applied ARMA model for JP Morgan's.
Okay.
So which lag is to be decided?
Okay. Can you share your
Yeah.
screen? Let me see your screen. Okay. You do one thing.
Yes.
Row wise, you go to row number 1 and column wise come to 4. So coordinate is 1 and 4. No, row wise 1, row wise 1 and column wise 4. Huh? Just the next one, just below that, and to the right hand side. Only that is possible. Only these three circles are possible.
4, 1.
So your ARMA order will be 1 and 4 or 4 and 1.
Okay. And this higher.
Higher we should ignore. Higher we should not take because you should start with the smallest possible. So you can try with MA1 and your ARMA 4 and 1 or ARMA 1 and 4. Yeah. Any other query?
Sir.
Yes.
So in areas there is an option of interpolation. So is something like that is there in Art Studio also?
No, interpolation is different. Interpolation, what you are trying to do, you're based on the availability of data, they are trying to make a projection.
Yeah.
But here data is not available, you're saying, right?
There are missing values, although lower values and higher values are available.
So interpolation, you can do that interpolation part also. But interpolation is basically taking the trend of the previous data and based on that trend, it is making a projection.
Yes, sir.
Which may not be a correct picture.
Okay.
Suppose you're talking about prices. The prices last 5 days has gone up very, very sharp. And otherwise the prices have come down very sharply. So what will happen? It will make an upward projection for your missing value, even if the price has actually come down.
Yes, sir.
So in that case, your result will be biased, right? So it's better to go for your median or average. If the data seems to doesn't have any too much of outliers, then you can go for either mean or median.
Okay.
Yeah. Okay, any more query? The concepts are clear: autocorrelation, stationarity. Then we have talked about the Jarque-Vera test.
Santanu, I was trying to install the package tidyverse. It's repeatedly saying one or more of the packages to be updated are currently loaded. Restarting. So do you want to restart R prior to install? When I'm saying yes, it's still
not required. Restarting is not required.
No, is it?
Oh,
okay. Fair.
Right.
Thanks.
Okay, so for tomorrow we are going to talk about volatility. So arch models and those arch family models we are going to talk about. And VAR also we are going to talk about. So if you are ready with these 3 libraries, then I think it will be better for tomorrow's class. First is FGARCH. That is one. Second is Are you guards? Third is
Sir, I am unable to see your screen.
okay. So I have not shared the screen. So these three libraries will be requiring tomorrow. And we are going to talk about integration. So URCA, these 4 libraries, if you can install, it will be good, so that we can start directly. Fifth one is, I think another one we can take, FNTS. This is for arts test we have to do. So that'll be okay. These 5 libraries.
Yeah.
Right. So this we are going to use for the arts and grants model. This one is used for arts test. This one is used for VAR model. And this will be used for co-integration. Right. So these are some of the models packages we'll require tomorrow. Okay, so if there is no other question, then I think we can stop here. And it's better that if you can practice something, maybe with your project or additionally with your own data set, that will give you an added control over what you are doing, right? So please repeat the things again and again so that you are clear with the step-by-step process of time series modeling. So till now, whatever we have done only for modeling for the written part. Tomorrow, we are going to talk about the risk part of univariate data. Right, and tomorrow we are also going to start with multivariate written model. Right, a bit about that. So this is the agenda for the timing. So can we stop if you don't have any other question?
Okay, sorry. I just had a question not related to this. In the multicollinearity, there was one library, data sets, is it? Or data series?
No, data set is the library, your library.
It's not coming up in repository CRAN. Data sets dot load. Yeah.
Let me see your screen. Okay, it is not coming. Okay. Do one thing. Open Google. Yeah. In Google, you type data sets, library data sets in R. Madam, you need to share your entire screen. I'm not able to see.
Okay.
Okay,
just a minute.
Yeah.
Yeah.
Library datasets. Okay, scroll down. Let me just check. Scroll down. CRAN website is there. Must be.
Yes,
This
this
one.
one?
No, no, not this one.
No,
No, this is a PDF that they will open.
PDF.
Mhm. That website we want. Okay, do one thing. Just type CRAN. CRAN.org. CRAN. Yes, enter.
Yeah.
Search button is there somewhere. Or either you say this one. No. Contributed extensions, older versions. Source code. Here. Source code available here. Maybe this you can click. Source code of older version of R. Available. Click on that. Okay, here you try to find out is dataset available? No. Okay, just a minute. Okay, let me find out in my system. Let me just.
Maybe tomorrow morning we can get it.
No, we can do this right now. No issues. Okay, it's there. Yeah, and do one thing. Please share your screen once again. Okay, no, go back. Again back. Okay, scroll up at the top. The first one you click. Okay. Now click the first option. That is the datasets package. This one on the left side. Click that. Why it is not giving? Description file. No. Let me just. Settings. Okay, let me just try. Okay, go to your R file. Let me just try R file. Install. You start typing datasets. Let's see. SCTS. Now install. Press install. No, don't select anyone. No, don't select anything. Take now install. No. Is in use. I mean, dataset is already there, I think. Can you go to the list? User library is there. No, on the top, your bottom right. Bottom right, the list of packages are there installed. So you just check whether dataset is there or not. It is saying that it is available. Okay, data is a graphical interface. No, it is not the dataset. Or can you execute line number 11? Let me see what message you are getting. It's working, no issue. I mean, just try in line number 18, you try. Line number 18, you come. Type data sets. ACTS. Second option. Select that. You see all the data files are there. Empty cars I have used from here. In that list, empty car is there. Madam, I think you are on mute. I could not hear you. Is that okay?
Yeah, that's fine. Yeah, thank you. Thank you.
So you will be getting all other kind of data. So if you want to practice your panel data or cross-section data, from that data set will be handy for you for practicing.
Okay, sir. Thank you so much.
Okay. So let's disperse for the day, and tomorrow we'll meet at 10 o'clock to discuss modeling, volatility modeling. So take care and good evening to all.
Thank you, sir.
Okay, bye.